Hello and welcome to Simply Tax. This is your host, Damien Martin. Oops, we did it again. We got lost in the game, and yet another year has flown by in the tax world that saw thousands upon thousands of pages of new legislation, new guidance, and as we'll focus on today, tax court cases that are packed with countless lessons and takeaways for tax practitioners and taxpayers alike. Now, if you're feeling overwhelmed or like you need to catch up a bit, don't let it play with your heart, as we once again have the honor to talk tax with a true tax celebrity, and I'd like to welcome frequent guest and friend of the podcast, Tony Nitti, for our third annual look at his top 10 cases of 2021. Like our previous top 10 episodes, we cover a lot of technical ground and of course layer in some tax fun and entertainment along the way. Before we jump in, I have a quick recommendation for you. I would highly recommend you grab something to take notes with, as I can pretty much guarantee you'll learn something and take something away from this conversation today. That, by the way, Tony impressively yet again did in a single sitting that you can find a behind-the-scenes look at on our Simply Tax YouTube channel. And with that, I'm excited to share with you on the podcast today, Tony Nitti's top 10 tax cases of 2021. We'll get started with the question I wanted to know from the start. How does this year stack up to our previous top 10 episodes?
It's funny that you asked that. I actually quantified that in my head a couple hours ago. For grading 1 to 10, I call this like a 6.5 type year. I think it's better than 2020, but not as good as when we did in 2019. So take that for what it's worth, right? It's just based on my internal metrics, but it wasn't a bad year. It wasn't an outstanding year. I think we have, I can't say 10 great cases because, when you sign on to the Simply Tax podcast, you're getting more return on your investment than that, right? I think we'll cover 12 cases / rulings, even though we call it 10. But let's be honest, when we go through precedent and all that, we're gonna mention 50 cases by the time the day's over.
Yeah, 10 is not the accurate number anyway, and I think that's always the best part of it. And I think it's kind of nice getting back to I don't want to say get back to cases, but for a while there, we're just so focused on the legislation and what's coming out in response to the pandemic and all that. Just there's something that's just kind of comforting, I guess, about getting into some case law here.
I'm not kidding you, dude. This is my favorite day of the year for talking tax. It really is. Getting on here with you. The best idea the two of us jointly ever had was 2 years ago, doing this in podcast form, rather than writing them all out. But I'm serious. Like, I get giddy as the day approaches. I really look forward to this conversation because, you and I, we love these conversations and the cases, sometimes I'll be honest with you. I think, it's a 5-minute discussion. And then you realize the tax law never works that way. And 30 minutes later, we're still talking about some nuance of it. I agree with you. There is something refreshing about going through case law because it can provide entertainment value or good theater, or like I said, just learning points versus what feels a little bit more mundane of interpreting new legislation where all you're left with is statutory language. There's no fun facts or there's no, interesting precedent. It's just, I don't know. What does it say? Does it say what I think it says, or does it say something else? Or is there a gap in the guidance? Yeah, I think you and I certainly enjoy this. It certainly appears, and you would know better than me, like the audience, as twisted as it sounds, likes listening to us go through these cases. Because I don't remember, where did we come out last year? Like 2.5 hours? I mean,
we topped out at 2 hours, 26 minutes, and 20 seconds last year. And if you haven't already, I would suggest you add episode 115 to your playlist. While you're at it, add 2019's top 10 list as well, which is episode 83 of the podcast, and you'll find links to both episodes in the show notes to this episode. I will tell you that, that the initial reaction, you think, oh, who wants to listen to that? Plenty of people do, and the feedback is great. Now, it's probably also a testament to, like you say, you add a little entertainment value and just the way you explain it, Tony. I've always enjoyed that, and I mean, I will say that looking forward to this episode and this conversation each year is a mutual feeling on my part as well. So
I'm going to go ahead and say, and I know I shouldn't say it, but I'm going to say there's no way we touch 2.5 hours this year. We had some meaty cases last year. We could, like,
you never know. We wind you up. We'll see where you go,
And spoiler alert, right? We're going to talk about your hometown Chicago Cubs case there, obviously. And we could spend 2.5 hours on just that. But instead, I'm going to try to boil it down to just kind of some, interesting talking points. But as you just said, you never really know. Once we get going, it's just going to end wherever it decides to end.
Got it. Yeah. No, and I think that's the best way to approach it, right? Is as long as it needs to be. So well, maybe we just jump in. I don't know, kind of with our first one here, which I guess maybe it's kind of a pair of cases you kind of teed up. So Holiday and Blum.
Yeah, so like I said, I like your listeners to get, more bang for their buck. So in case number one, we're actually going to talk about two cases. I think by the time we're done with it, we'll probably have touched on five or six. I like this case a lot. What better place to start than the very definition of income, right? Like what's included in gross income. But I also like this case because a lot of the relevant history is in our industry, is in the tax preparation world. So, what happened here in Holiday? You had a taxpayer, a woman who was getting divorced. And so she hires a divorce lawyer. Her divorce lawyer takes her through mediation. She's not crazy about going through mediation, but she does it anyway. Mediation does not leave her satisfied, right? So the judge rules. She's not happy with the outcome. And she goes back to her divorce attorney and just says, listen, you left money on the table. There's this retirement plan my husband's got. I didn't get my piece of that. I got shortchanged about 75,000 bucks. You need to appeal this mediation and get me my 75,000 bucks. So the divorce attorney, files for a new hearing, I should say. That gets denied. And in his hearing, he does say, like, hey, we got shortchanged 75,000 bucks here, but it gets denied. And he says he's going to appeal, but he just never does. So he promises to appeal, he doesn't appeal. So case closed for her. So that's litigation number one that we have to kind of separate in this case. Litigation number two is now she's angry, Damien, right? So she hires another attorney to sue the divorce attorney. And she sues for malpractice. She sues for, breach of fiduciary duty, breach of contract. What she doesn't say anywhere in her suit is like, hey, I got shortchanged 75 grand. You better pay me 75 grand. That's not anywhere to be found. And that's going to be very relevant. Instead, she says, you didn't do well by me. You committed malpractice. I'm suing you. So she ends up settling with the attorneys and they pay her about 150 grand, maybe a little bit more if I remember. And they say to her, like, listen, we're settling for your claims, no more claims of breach of contract, malpractice, but they're not saying anything about, hey, we're giving you 75 grand to compensate you for what we didn't get you in this, underlying mediation that you say we should have gotten, right? I mean, that was never like proven. It was never established that she got shortchanged to 75,000. It was a contention that she raised and, it never kind of went through mediation and the attorneys certainly didn't concede to it. So they said, we're going to pay you about $170,000 to just go away and drop all your claims. So that's it. That's the fact pattern. It's not overly complicated. It's the precedent that's fascinating, right? It's the law that's fascinating. So she gets a 1099, obviously, for this $175,000 settlement payment. And what do you think, right? She does not include it on her tax return. So the question is, why and was she correct? So, Damon, if we start in the ground floor here, we know that the general principle of the tax law is everything is income unless you can prove it isn't. That's what Section 61 says. Ignoring 61 for a second, we have the 1955 seminal Supreme Court case, Glenshaw Glass, that says, hey, if you have an accession to wealth that's clearly realized and over which you have complete dominion, you've got yourself taxable income. So we would start from a baseline where, hey, if you get a $175,000 settlement payment, are you richer than when you woke up in the morning? Certainly appears so, right? Do you have control over it? Yeah, it's in your bank account. Go do what you're going to do. Has it been clearly realized? It has. So we would start from a presumption that, hey, Section 61 in Glenshaw Glass would say you've got income. But we know that there are obviously exceptions to the general rules. And one of them in this settlement arena, I believe we've talked about before, you and I, Section 104.
We sure did, and it was included in our discussion on Beckett versus Commissioner in episode 115, starting at 1 hour and 33 minutes and 28 seconds.
Yeah, 104 just says, look, if you have a settlement or a judgment that compensates you for personal injury or physical harm, right? The idea is you might be getting a settlement for 200,000 and feel richer, but you're actually just being made whole, right? So if I go across the street and a van skids on some ice and hits me and tears my ACL, and I spend months rehabbing and all of this stuff and blood, sweat, and tears trying to get back to who I was, if I sue that van driver and get 200 grand, yeah, I might feel richer, but in the eyes of the IRS and Congress, that 200 grand just made me whole, right? It's like if we had basis in our bodies, it'd be like when we got hit by the car, we were damaged, and that $200,000 settlement just replenished us. And so instead of picking up income, we would just reduce our basis effectively, right? Now, if we sue somebody and we get punitive damages, that's not excludable under 104 because that's not being made whole. That's punishing somebody for their behavior. Or if we get paid for medical expenses that we previously deducted, that's not excludable either because we already took the deduction. But if we get compensated for being injured, 104 tells us it's excludable. And you and I have gone round and round about, well, what is a personal injury? What's emotional distress? What happened? So we have this concept in the tax law that's codified that sometimes when you get enriched, you're not really getting enriched, you're just being made whole. And that concept exists even in the context of non-personal injury, because sometimes, even if we're not physically hurt, when we sue and recover, we're just being made whole. And I think like the classic example I always use for this when I teach it is it's Rev Ruling 81-152. And you've got a taxpayer who bought a condo, right? And let's say they spent 400 grand on the condo. And then it turns out there's shoddy workmanship and they sue the builder. Well, if you recover 50,000, you're not richer. You spent 400 grand, on a poorly constructed condo. That 50 grand that you recovered is just making you whole. And so we know that even though it's not codified like 104 is, that in some settlements, you are deemed to just, you're just being made whole, just like in the condo situation. All right. And so in this case with Holliday, she said, I'm not picking up this $170,000, whatever it was in settlement income, because I'm being made whole for the payment that my attorneys did not recover from my ex-husband. Now, what she doesn't address is, you said that payment was only 75 grand, and here you've got 175 grand, but never let the facts get in the way of a good story. But she's saying, hey, if I had gotten that 75 grand, it would have been tax-free under Section 1041, right? You can transfer property into a divorce tax-free when you split up a marriage. You failed to get me that 75 grand. Now I'm settling with you. That's to make me whole for what you didn't recover from my ex-husband. So that is her premise, kind of like this condo premise that I got hurt. What you're paying me now doesn't make me richer. It simply makes me whole for what I should have got. Okay. So is she right? That's where this awesome case history comes in that impacts our industry. And it goes all the way back to 1939, a case called Clark. And you talk about simple facts, Damien, right? Tax preparer prepares a return for a husband and wife jointly. But if they had done it separately, it would have saved them $20,000. So the clients go after the tax preparer and say, you made us pay through your mistake an extra 20 grand. We want you to pay us 20 grand. The preparer does it. And the client says, I'm not picking this up in income because it made me whole. And the IRS disagreed, but the courts agreed. The court said, yeah, this was a mistake by a tax advisor. You can show they harmed you to the tune of $20,000. Like, it's easily quantifiable. If you had filed separate, you would have paid 20 grand less than if you filed joint. They didn't do that for you. It was a mistake. When you recover that 20 grand, you're not richer because you paid an extra 20 grand to the IRS. You're just being made whole. So then fast forward 75, 80 years to about 5 years ago, a case I wrote about for Forbes at one point, Cosentino. And in the Cosentino case, kind of an extrapolation of what happened in Clark, but with a little twist. Here you had taxpayers who routinely engaged in the time-honored tradition of building wealth by doing 1031 exchanges and holding that property. The plan was until they die, right? And then you pass it on to your heirs at a stepped up fair market value basis and everybody's happy. So they were content to just keep doing that 1031s, 1031s, 1031s. But a tax advisor came along to them and said, you know, there's a way you can do 1031s and get some cash off the table and not pay tax. You and I both know if someone's telling you you're going to have cash in your hand and not pay tax, you either got to be really crafty, like the Cubs case we're going to talk about later, or it's a tax shelter. Something's wrong. And it turned out this was a well-known tax shelter. And so the client here, ended up having to buck up like $500,000 in additional tax and penalties and interest. And so they went after the advisor. And under the same kind of theory as Clark, the court sided with the taxpayer and said, hey, you were content to go through these tax-free 1031s your whole life. The advisor put you into a shelter, caused you to pay more money. And so when you recover, you're just being made whole. Okay, interesting. But the IRS refused to acquiesce in that case because they said there's this critical distinction between Clark and Cosentino. In Clark, tax advisor screwed up, made a mistake. You should have paid 20 grand less. In Cosentino, this wasn't a mistake. They put you into a transaction that they knew about. You agreed to go into that transaction. The amount you paid was what you should have paid given the transaction that you voluntarily entered into. Was it a tax shelter? Yes. Was it, bad advice? Yes. But you paid the right amount based on the transaction you voluntarily entered into. So the IRS was not happy about that ruling and they refused to acquiesce. And we saw that kind of come home to roost in 2020 in a case called McKinney, which I don't think we had on our docket last year, but hey, we'll throw another case in, right?
No, we haven't covered it, but we included a site for the case in the show notes this episode in case you want to check it out.
In McKinney, same thing. Taxpayer got talked into kind of a shelter with ESOPs and an S corp by a very well-known accounting firm, not your firm, not my future firm, but a very well-known firm that all our listeners would certainly recognize. And they had to buck up over $2 million in penalties and interest. And the IRS just kind of said, hey, just like we said in the Cosentino situation here, sorry, this was not a mistake. You voluntarily entered into this transaction and you're paying the right amount based on the transaction you entered into. And here, the IRS actually won. The facts get a little clumsy. The real reason they probably won was more because they couldn't prove their tax advisor had made any type of mistake. They claimed that they had. They claimed they failed to make an S election timely, blah, 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 but they could not prove it. And so here they lost, right? And so what we start to learn as these cases evolve in the tax industry and how this comes back to our case here with Holliday is what they're really looking at is, what are you alleging in your claim? Can you prove, can you quantify that some mistake cost you to pay more than you otherwise would have, or in this case, to receive less than you otherwise would have, okay? And if we needed one more piece of kind of precedent for the court to settle this case, they didn't have to go back far. As you alluded to, we had a second case in 2021, Blum. And Blum was a very simple fact pattern as well. You had a lady who got injured. She went to the hospital. They put her in a wheelchair and the wheelchair breaks and she gets more injured, right? And so I don't understand how they didn't win this, but she hires an attorney. They sue the hospital. They don't win any damages. Now, had they won damages, there's no question they would have been excludable under 104 because of personal injury and physical harm, right? I mean, she got injured. So just like Holliday, now she's mad at her attorney and she hires another attorney, right, to sue her attorney for malpractice. But just like Holliday, nowhere in that suit is she alleging that they caused her physical harm, that they hurt her, that they owe her for her pain and suffering. She's saying, you committed malpractice, you screwed up, right? Breach of fiduciary duty. So she settles and she wins, but when she wins, she excludes the income because she says it's replacing what would have been tax-free under 104. And the courts just say, hey, I get it. But what we've learned in Clark, in Cosentino, and other cases is we have to look at your specific claim. And not only did you not claim that your attorney physically harmed you, the settlement agreement language actually says right there, we are not paying you for any physical injury. We did not injure you in any way. And so I know it seems unfair, right? If they had recovered, you would have excluded it under 104, but whatever they're paying you because they didn't physically hurt you, it's not excludable. I'm sorry, you lose. So then you take that concept back to Holliday after that long digression we just went on, Damien, but bring it all back to Holliday, and they look at her claim against her attorneys for malpractice. And again, what it says is you screwed up by not filing appeal, right? You didn't serve me well. It doesn't say anything about I was owed 75 grand. You didn't get it for me. Now you owe me 75 grand. And the settlement agreement didn't say we're paying you 75 grand to compensate you for the 75 grand we failed to get you. And so the court concluded, hey, very sorry here, but unlike Clark, unlike Rev ruling 81-152, you can't show, you haven't established, you may be claiming, but you can't establish that you were harmed to the tune of 75 grand and that they're just paying you back for that, right? I mean, you're alleging that you were shortchanged 75 grand, but no one ever concluded that that was the case. And so you're richer, right? You haven't showed you were harmed, so you're richer and you got to pick up the whole amount as taxable income.
Wow. Yeah. I mean, it's just interesting, right? I mean, I don't know. My takeaway is just listening to this, and like you said, something seemingly simple and straightforward clearly is not, because there's so much involved, and it's facts and circumstances. What I'm kind of hearing you saying is those facts and circumstances actually have to kind of be in the plain language of the settlement agreement for you to be able to get there, even if it's once removed. It's perhaps even more important, right? Because I mean, both of those are sort of once removed situations.
But, even when we talked about 104, the settlement agreements are critical, absolutely critical. And if you don't have a tax savvy person looking over them, even when someone has clearly been physically injured, you can screw up and end up, with payments that are allocated to emotional distress or punitive damages, and then you're picking up income. And so, yeah, it is. And again, I think why I liked including Holliday and Blum is we do get that digression into our own industry and the notion that we can harm somebody by making a mistake. And I just always find it fascinating that when you get a fairly straightforward set of facts like this, we're talking about cases from 1939. I mean, that's how the law is built, right? On the relevant precedent. And it can be a seemingly, like you said, innocuous set of facts. And we're citing case law from darn near a century ago. And I just love that aspect of the case law, that it's built on this foundation and these layers that never disappear unless they get overturned.
Right. It's kind of just the story just sort of evolves. And like you say, even if it gets overturned, that sort of just adds another like branch to the tree or something. I don't know what the right metaphor would be. I'm trying to come up with a good metaphor here, Tony.
The best way I can explain it, Damien, is when I teach grad tax, and I love when we start the semester learning some of the seminal cases, the Eisner Comers and the Glenshaw Glasses and the Grotzingers. And then I love as the semester goes on and they just read more and more cases that cite those cases, and then they start to recognize all these cases being cited, and they're like, oh, okay, like this all ties together in some magical way.
Yeah. It's almost like, and this is a recent experience I had with my kids. My son watched Star Wars for the first time here recently. You talk about a kid that like his eyes just like were just, I think, just like peeled open for like the entirety. He's like, we got to watch them all like back to back. But it was sort of like this, well, wait a minute. Like now I got it. Like there's this depth. So it's like the Star Wars equivalent to the tax law or something. I don't know.
I know exactly what you're saying. You're not opening up something this big. You're realizing that it's this big.
Want to know just how big? Just like last year, we'll be releasing videos on our Simply Tax YouTube channel for each of Tony's top 10 cases this year. We'll be dropping them all at once soon after the release of the episode, so subscribe to the channel so you know when they're available. maybe we'll see if we can't get some of these layers here on your next case here, which deals with section 121.
I give careful consideration, not just to the cases we choose, but the order. So, we try to get a little reprieve because let's be honest, I think we just went probably close to 30 minutes on that first case. So if we extrapolate that out, we'd be here for 5 hours. So we don't want that. But don't worry, some cases will be quicker than others. I love section 121. When I do teach this in grad school, I always explain it's a chance to make you a hero, right? For family and friends. And it's one of those provisions that you can yield in real life to really bail somebody out of a sticky situation. So what are we talking about here? We've got these taxpayers, right? And in the year 2000, they buy their house. And you get an idea in the case that things aren't really great financially from this family from the very beginning, right? Like they've got this insanely high interest rate on their mortgage here for this first house. And then at a certain point, like they can't even get a mortgage anymore, and they have to have a friend go out and borrow a mortgage for them and basically allow them to pay him back. So things are not ideal from a financial perspective here for this family. Nevertheless, in 2003, so 3 years after they buy their first house, even though clearly there's signs that they're struggling, they go out and buy a plot of land that they want to build their dream home on. So they're spreading themselves pretty thin, Damien, and this is relevant. And so they start building their dream home in 2004. Then they get to 2005. And in 2005, they sell that first house to a buyer, taking back a buyer's note. Never a great idea, right? You're assuming some risk there that the buyer is going to come through and pay. What ends up happening here, and it becomes really the critical piece of this case, is the buyer does not end up paying on this note. They end up defaulting on this note. But what's critical is when, and we'll get into that. And so in December of 2005, and this is a big date, right? Because we're talking about a case that's hinges on dates here. December 2005, they move into the dream house that they built. And things are definitely tough financially, but that doesn't prevent them from going out and spending 400 grand on a piece of land adjacent to their house. And so they just keep digging their hole deeper and deeper and deeper. So they move in December 2005. The buyer, as I said, on the previous house ends up defaulting. They don't get paid. And this isn't a small purchase price. I'm talking like a $1.5 million purchase price they end up not collecting. Financial conditions get so bad that in September of 2007, they sell the dream house that they've been living in. Why do we care about that? They moved in December 2005. They move out, sell in September 2007. Not quite 2 years, about 1 year and 9 months. And it's a significant gain. They sold this house for over $2 million. Now, we know that normally, you sell any asset, a residence for a gain, you're paying tax on it because we said any accession of wealth, right? Glenshaw Glass, you have income. But as we said before, we have exceptions to that rule. And one of those exceptions, the exception that most normal, just average Joe people will avail themselves of at some point in their lives is 121. And 121 says you can exclude gain on the sale of a residence as long as you have used it as your principal residence for 2 of the previous 5 years and owned it as your principal residence for 2 of the last 5 years. So there's this ownership and use test, and it's 2 out of the previous 5 years. You meet that test, you can exclude up to 250 grand if you're single, $500,000 if you're married. I mean, it's huge, right? Obviously,
oh yeah,
especially in today's real estate market, it helps taxpayers out a lot. What I like about 121 is all the quirks. There's so many quirks, like about ownership, I should say, getting attached to someone who didn't own it if they get the house in a divorce, and after death, how long are you deemed to use the house or own the house if you're spouse? There's all these little quirks. One of the quirks that I just want to point out that throws people off a lot of times is when they say you have to own and use the house for 2 years out of the last 5. A lot of people misinterpret that to mean I just need 24 months of use in the last 5 years. And so let's say you split your time between New Jersey and Florida, and you're in New Jersey 7 months a year and Florida 5 months a year for 5 years. Well, you sell that Florida house and you go, wait a minute, I lived there 5 months a year for 5 years. That's 25 months in 5 years. That's more than 2 years. 2 years is 24 months. But the thing is, the definition of principal residence is such that in any given year, you can only have one principal residence. It's where did you spend the majority of your time? And in none of those 5 years was your Florida home your principal residence, because you lived in New Jersey for 7 months and Florida for 5. So it's not just a straight, if I get to 24 months, I'm good. In that situation, you never had a single year where that Florida residence was your principal residence, right? So again, not to continue to be a shameless self-promoter, but maybe 2 years ago, I wrote a long 121 article in Forbes that walks through all the kind of little quirks. The last quirk I got into in that article is what this case is about. So this couple sells their house in September 2007. They moved in December 2005. That ain't 2 years. But the statute and the regulations say if you don't make it to 2 years of ownership and use, you can use a reduced pro rata exception if you meet certain requirements. And the key to these requirements is something really bad had to happen while you were living there, right? Like you got sick, or you had to move jobs, or you got disabled, or you had extreme financial hardship, right? Or natural disaster. But the critical thing, Damien, is at the time you moved in, you couldn't reasonably foresee that that really bad thing would happen. All right. And so you could see how it would be a little tricky here, because, like, how do you make that determination? Before you moved in, it couldn't be reasonable to foresee that you were going to switch jobs or you were going to get sick. I mean, the sick thing is pretty easy, right? That makes some sense.
Sure.
These taxpayers, what they were doing here in this particular case, and it's a little unsatisfying for this reason, is they were both appealing the court for summary judgment. They just said, we want this case thrown out because, you know, we both argue that we're right. Case closed. Very simple. There's no material dispute as to the facts. And what the IRS was saying is, very sorry, these people cannot argue that they sold their house because of their financial hardships and that it wasn't reasonable for them to foresee this happening, because they knew darn well before they moved in 2005 that they are having financial hardships. They had a high interest mortgage. They had a friend taking out a mortgage. They had, you know, this default on the house that they had sold. So they knew they weren't going to collect those payments, but they still went out and spent 400 grand on a plot of land. But the taxpayer said, hey, not so fast. The thing is, even though you say we didn't know we weren't going to collect that note until after we moved into the house. And so, as I said, the critical determination here, there's actually two of them, is number one, you couldn't reasonably foresee these circumstances arising before you moved in. And then two, those circumstances have to be the primary reason you end up selling the house. Nobody was arguing that they had sold the house for the primary reason of financial hardship. What they were arguing about is the IRS was saying you should throw out the case because they knew darn well they were in financial hardship before they moved in. And the taxpayer was saying, we did not know we were in financial hardship until we found out we weren't going to collect on that buyer note. And that didn't happen until after we moved in. And long story short, Damien, again, this is where it's not quite satisfying. The court said, we need more. We need to understand more because we don't have a great timeline. We can tell there was definitely some understanding that you were struggling financially before you moved in. But what we really need to understand is, when did you know for sure you weren't going to collect on that buyer note? And so we know there was some financial hardship, but there is still a possibility that you didn't truly know how bad things were until after you had moved in. And so we don't have a winner declared in this court. They just refused to, award summary judgment to either side. So now they're going to have to go back and say, how do we know at what point in time you truly knew you were up against it financially, right? Like you knew that you weren't going to collect on that note. Now, I will say to you, one of the reasons I chose this case is it gives me a chance to talk about, to me, what is one of the most fascinating PLRs in the last 10 years. And it shows how flexible the IRS can be sometimes with these unforeseen circumstances. You had this PLR 2016-28002. And what it did is think about everything we just talked about, right? You move into a place, you can't reasonably foresee circumstances that end up arising and cause you to sell it. In this PLR, Damien, you got husband and wife with one baby. They move into a 2-bedroom condo. A year goes by, they find out they're pregnant, and they sell the condo after only 1 year of the 2. And so must have sold the condo for a big gain because they wanted to avail themselves of the reduced exclusion. And the reduced exclusion would be simple. If you owned and used it for 1 year instead of 2, you would take 1/2 of your eligible exclusion, right?
All right.
So they appealed to the IRS in a PLR and said, when we moved in and had our one child, we could not reasonably foresee that we would have a second child. And the IRS agreed, which I find just kind of insane because listen, like, we're all adults here. You engage in certain behaviors, there is a possibility you're going to have a second child. And a young couple with one child, how can you argue it was you couldn't reasonably foresee that you would have a second child, need another bedroom, and have to sell your 2-bedroom condo to get a 3-bedroom home or whatever it may be? But the IRS sided with them in that PLR, and they said, hey, we don't think you could have reasoned. Now, in the regulations, they explain that if, like you have twins, right?
I do. Yep.
They explain in the PLR, or in the regulations, if you have twins when you own a house and suddenly you're like, oh boy, I need some more space, that's a good reason to sell a house under the unforeseen circumstances rule. But having one child and then having a second child a year later, I don't get how you can't reasonably foresee that. Again, I like this case because you have this critical determination. It's not just about why did we sell the house. It's could we have known that circumstance was going to arise before we moved in? And that's, again, what I really enjoy about this case is like, it's so specific that the IRS said we should win because they knew they had financial hardship, and the taxpayer said we should win because we didn't know how bad things were until after the date we moved in. And now they're going to have to go back and trial and prove, when did you know?
And I'm just sitting here thinking, as you're talking about, if I had this come to me, right, and this fact pattern. So I'll ask you this. I mean, what do you do going into, like, if you're talking to this family here with their hardship and wanting to claim it, how do you approach it?
Boy, I'll tell you, based on the facts that I saw in the case, I would have a hard time believing or being comfortable taking the position that unforeseen circumstances had arisen that forced them to sell that house, right? Because again, I mean, their financial struggles are well documented from 2000 to 2005 before they moved in. But their counter argument is that, hey, we could have survived those struggles. It was not collecting on the buyer note that really killed us. So I get it. I understand why they'd want to pursue it. It's just my understanding of the common definition of an unforeseen circumstance is that you really, it's got to come out of the blue, like a natural disaster or getting sick or a change of jobs. But if you're struggling financially where you can't even get a mortgage, hey, man, it's hard for me to argue that you didn't see this coming.
And back to your comment about having the twins and the regs, I'll tell you that is an unforeseen thing. And you talk about game changer there. That's for sure. All right. Well, we're technically 2 cases in. I think we've covered 6 already. I'm taking notes here, Tony. It's just I got to see what cases we come up to. But our technical 3rd case here deals with a really neat code section, I think, 1244.
That's why we picked it.
What do we got going on here?
All right. So the next 3 cases, well, there's a case, rulings case. There are public service announcement. That's why we chose them, right? This case in particular, is there anything really illuminating in the case itself? Not really. But what we want to do is alert listeners to the existence of 1244 and make them understand, when we should be thinking about it proactively. And then we're going to get into 1202. We're going to get into 1341. 3 provisions that I think the main hurdle to them is knowing they exist, right? Okay, so Damien, right? We've all got that family member somewhere on one side of the family or the other that, fancies themselves an entrepreneur and wants to keep starting up businesses, and then they come knocking on your door for an investment, right?
Sure do.
And we know it's going to fail. It's always failed. It's going to continue to fail, but we still have to buck up and make an investment. So the question is, right, there's 2 ways to make an investment in this doomed business. We can make a loan or we can invest some equity. And in a perfect world, we might want to make a loan so we can collect some interest and what have you and take back collateral. But we know we're not getting paid interest because we know we're not even getting paid principal. Again, we know that basically we're making a charitable contribution here because this thing's going to fail. And obviously, I'm exaggerating, but I'm trying to make a point. Trying to make a point is if you're worried that an investment is going to go belly up, is there an advantage to doing it one way or the other, debt versus equity? Well, let's say we do this thing as debt, right? We loan an amount to this fledgling C or S corporation, whichever of the two it ends up being, and it goes bad and we don't get our debt back. Well, the treatment there is under Section 166, right? Bad debt deduction. But the crux is it is extremely difficult for an individual to claim a business bad debt. And the reason you want a business bad debt is a business bad debt is an ordinary deduction, whereas a non-business bad debt under 166 is a cap loss. And we always want ordinary losses more than cap losses, right? I mean, that's just how it goes. So as an individual, the only way you can really argue that you have a business bad debt is if the loan is made as part of your business or you are in the business of making loans. So if you just make a loan to your cousin's startup company, you're not getting a business bad debt. Now, there is a case called Generis with a G, where if you make a loan to a company that is your employer and the loan is small relative to the size of your salary, you can argue, hey, I'm making that loan to protect my business as an employee, and I can actually take a business bad debt. And the funny thing is, people used to fight and fight and fight to get this business bad debt. We had cases like Generis and Trent. Oh, I want this business bad debt as an employee. And the funny thing about where the law sits now is if you fought for that and got that business bad debt, you'd actually be worse off because it would be an unreimbursed employee expense, other miscellaneous itemized deduction, gone by virtue of Section 67G until 2026. Yep. So you're actually better off with a capital loss right now. So long story short, bad debt as an individual, you loan it to your cousin's startup company, it goes bad, you're taking a cap loss, okay? Now, what if instead you put equity in? Well, if the equity goes worthless, that's governed by Section 165. And what 165 does is say if an investment goes worthless, it's deemed to have been sold on the last day of the tax year. Now, why is that critical? Because in order to have capital gain or capital loss, you got to have two things. You got to have a sale or exchange of a capital asset. And so if you hold stock in your cousin's company, we know it's a capital asset, but if it goes worthless, there's no sale or exchange. You didn't get any value. So what 165 does is it forces sale or exchange treatment on us by saying worthless stock is treated as if it's sold the last day of the year. And so we get stuck with capital loss treatment anyway, right? Now, we don't probably need to go down this path, but it is interesting to note the proposed legislation in the reconciliation bill would actually do two things. It would move that deemed date of sale for worthlessness from the last day of the tax year to whatever day it was actually identified as worthless, which I have no idea how you do. But the second thing it would do is try to reverse Rev Ruling 93-80, which is the Rev Ruling that says if you walk away from a partnership interest and the partnership has no liabilities and you abandon it, even if it's not worthless, if you abandon it, you can get an ordinary loss. This new legislation would say abandonment will now be treated as akin to worthlessness. And so since worthlessness is a deemed sale or exchange, now you won't be able to get any ordinary losses if you walk away from a partnership because you're going to get this forced sale or exchange treatment if this legislation goes through. So you'll get a capital loss. Okay, none of that has anything to do with what we're talking about here. So at this point, right, at this point, whether we make a loan to our cousin's company or put in equity, if it goes bad, we're getting a capital loss, right? Because if it goes worthless, we're treated as if we sold it on the last day of the year. That's capital loss treatment. But if you're aware of Section 1244, which, as you described, is a neat little provision, then the game changes, but only if you're aware of it. So what happened here in the Ushio case? And then we'll talk 1244. Really simple set of facts, clumsy case, way too many missing pieces for my liking. But you got a guy who forms a C corporation in 2009. And I don't know how this can be hard to establish, but he claims he puts 50 grand in for 50 shares of common stock. That's it. That's all. But yet, the whole point of this corporation is it was supposed to invest in an LLC, and it was supposed to put, over $1 million into this LLC. Well, where's that money coming from? Presumably, it was going to come from this taxpayer, the shareholder. So he had like this schedule of amounts he contributed. In total, it was over $1 million, but he claimed that part of it hadn't been contributed. All of this becomes relevant in just a moment. The company's supposed to invest in an LLC, never does anything, never generates $1 of revenue, nothing ever happens with it, and he dissolves it in 2013. And so he ends up being audited for other issues. And the IRS says, you should take a capital loss for this bad investment that you made. And then someone must have alerted him to the presence of 1244 because he says, wait, I'm going to take $50,000 of ordinary loss. Okay, now it's time. What is 1244, right? Well, what 1244 is it's a provision that says, and I want everyone to think of this as a companion provision to 1202 that we're going to talk about next, is it says if you invest in certain qualified kind of small business stock and you end up selling it for a loss or walking away from it in an abandoned, like a worthlessness situation like this where you get capital loss treatment, we're going to go ahead and throw you a bone. And we are going to let you take up to $50,000 of the loss as ordinary, or if you're married, $100,000. So he comes in and says, I'm going to take a $50,000 ordinary loss. I can't for the life of me, Damien, figure out why it's only 50. Is he arguing he only put in 50? Because he's married, it's a joint return. So I can't figure out why it wouldn't have been 100 because it sounds like he certainly put in more than that. But anyway, not the point.
Sounds like maybe, when he's at the golf club or the country club, at the golf course, the guy only told him about the 50,000. He didn't tell him about the 100,000,
That's it. They didn't read the parenthetical.
You
right?
get the parenthetical there. Yeah. Gotta read the footnote.
So anyway, he takes the position he can use this 1244. So 1244, to have this qualified investment, you got to meet a couple of requirements. Number one, it can be a C or an S corporation, and that's different than 1202. We'll talk about 1202. That's very specific to C corporations. Here you can have a C or S, right? You have to acquire the stock at original issuance, which is another common theme we'll see in 1202. It just means that Damien's a shareholder. I can't buy Damien shares. I got to get my stock directly from the corporation in exchange for cash or property. Then we have this rule that for a 5-year window, they don't want more than 50% of your gross receipts to be attributable to passive investments like rent and royalties and interest and dividends, okay? Now that rule is ignored if you run a loss every year. And I know I'm getting too much into the weeds, but in the committee reports, there's this overarching concept that you do have to prove you're an operating business. You're actually doing something. And then the last critical piece is it's for small businesses. And the way they define small businesses here is they say the cumulative amount of cash and property that's been put in by the time you receive your stock was under $1 million. So that's small. We're talking small companies, right? Very different than what we're going to talk about in 1202. So this guy claimed that his corporation he formed was a 1244 corp, under $1 million of total capital that went in and, met all the different requirements. The court shut him down pretty quick, Damien, for 2 reasons. Number one, and again, I don't know why this is hard to establish, it was not clear to the court at all how much cash he had originally put into this thing. Was it over $1 million? Was it not over $1 million? They said he could not clearly establish and document that this met that $1 million standard under 1244. But even if he had satisfied that, there is this overarching concept in the committee report that says you got to be an operating company. And this company never had a penny, not a single penny of receipts in its, 4 year run. So they shut him down and said, you don't get 1244 here because you can't establish you were a small corporation. You can't establish that you were an operating company. And so we're shutting you down. But for our listeners here today, this is important, right? If we're going to loan or if we're going to give money to our cousin's startup business, and in the back of your mind, you're like, this is a donation because it ain't going to go well. you may, be interested in doing that as equity rather than debt, just so that you can claim an ordinary 1244 loss if your worst fears are realized and this thing goes belly up.
Yeah, but mind the details, right? I mean, certainly, and making sure that it actually meets the definition there. Got to read the code section and the committee report for sure.
But that's awareness, man. Like, you know what I
Yeah,
mean?
yeah.
1244 is about awareness. It's so easy to slip through the cracks and not even know it's out there. And then next thing you know, you're dropping a capital loss onto a client's return and you don't realize it's a 1244 company.
You miss an opportunity there. Yeah.
Yeah.
So the next one, definitely, I'd say from awareness perspective, you talk about 1202, it's definitely, I feel like, built up and getting to more eyes and ears, I think, particularly after the TCJA. And I'll tell you, so this way you don't have to plug it. Your tax advisor article on the topic is just, it's fantastic. I mean, it is the article in my mind. If anybody you need to direct back to, hey, explain this qualified small business stock thing to me, that's the one, if you ask me. Obviously these next, what we're going to deal with here isn't cases, I guess, but we'll get maybe honorary case status, I guess. There are precious few amounts of guidance on 1202, I guess. So maybe with that, why did you pick these two PLRs and what the heck is 1202?
For the exact reason you just said, because anytime we get any guidance on 1202, it's got to be celebrated. It's got to be acknowledged. I appreciate what you said about the 1202 article. And the reason I wrote that 4 years ago, maybe 5 years ago, is because I was teaching at the DC Bar Association. There was like maybe 80 attorneys there in the DC area. And halfway through the day, I was touching on 1202 and I asked for a show of hands. How many people had ever worked in 1202 or were aware of what it did? 3 hands went up and it just scared me to death because it's such a powerful provision. Now, I will say I've continued to ask that question over the years as I teach, and it's getting so much better. Every year more hands are going up. But I know it's not great because that article you just referenced, there is not a week of my career, and I'm not making that up, that goes by that some CEO or some founder or someone somewhere doesn't call me because of that article and say, my accountant's not familiar enough with 1202. Can you help us out? And so I know it's taking food off my table theoretically, but like we got to still spread awareness of 1202. And so are these two PLRs earth shattering? Absolutely not. Do they give you and I a platform to raise awareness on 1202? They do. And that's what we're here to do, right?
All right.
So think about it, right? You've got a provision that a lot of people aren't aware of, but that provision says if you acquired certain stock after 2010 and hold it for 5 years, you can exclude 100% of the gain up to the greater of $10 million or 10 times basis. And my response to that is, where else are you getting that in the Internal Revenue Code? Where else can you start a business in 2011 for $100 of stock, right? End up selling it in 2018 for $14 million and exclude 10 million. Pocket the cash and pay no tax on $10 million. It doesn't exist. You can't. Like we're going to talk about with the Cubs, if you want cash, you're paying some tax or you're going to end up in tax court. And so we need awareness of this provision. We don't have enough awareness about this provision, but what we really don't have enough of is guidance. Okay. Why not? I'll give you the brief condensed version. This law was added to the code in 1993. And it said at that time, stock issued after today, held for more than 5 years, you get a 50% exclusion. And back then, the cap gains rate was 28%. So a 50% exclusion means you're paying an effective rate of 14% instead of 28%. We're on board with that. That's good. But you had to hold it 5 years, which means you couldn't possibly sell till 1998. Well, guess what happened in 1997? Congress lowered the cap gains rate to 20%, but they said any 1202 gain that's still includable because of the 50% limit remains subject to a 28% tax rate. So I'm no genius, Damien, but if you're paying a 28% rate on 50% of the gain, that's a 14% effective rate. So now you're comparing a 14% rate to a 20% rate. It's not all that exciting.
Right.
And then guess what happens in 2003? They drop the cap gains rate to 15%. So now you're comparing 15 to 14 and no one cared about 1202. And so no one used it. And because no one used it, we didn't get any cases. We didn't get any rulings. And then in 2009, they tried to breathe life back into it. And they said for stock acquired after this date, hold it 5 years, you can exclude 75% of the gain. Great. Then the real miracle happened in late 2010 when they said stock acquired after this date and held more than 5 years, you can exclude 100% of the gain. 100%. Okay.
It's huge. Yeah.
Those stocks started to be sold in the tail end of 2015. And that means they were reported on a 16 return, maybe picked up for audit a couple years later, maybe just kind of working their way through the courts now. So when I say there's no guidance, Damien, it's been around since 93. In that period of time, we've got one court case and what amounts to now, after this year, 5 private letter rulings. That's it in almost 30 years. You and I talk a lot in this podcast every year about the real estate professional rules. Also added in 1993, one case or 5 pieces of authority, that's one good month for the real estate professional rules.
Right. Yeah.
Yeah, you've got this area of the law that's basically been dormant. And now all of a sudden, it's this huge incentive. Now, the unfortunate part is the proposed reconciliation legislation would say for sales after September 13th, 2021, if your taxable income, including the gain from the stock we're talking about here, is over $400,000, we're going to send you back to a 50% limitation. So we don't know if the Senate's going to pass it anything, but if so, if that 1202 piece will be in there, but we may be looking at a haircut on 1202 again. But still need to raise awareness, right? Because it's still significant. And so a couple just things, right, to know about 1202. First things first, there's certain tests that have to be met on the day you get the stock. 3 things that we'll talk about quickly. Number 1, it's got to be stock in a C corporation. No S corps, no partnerships. And the day the stock is issued, it's got to be C corp stock. So what you can't do is form as an S corp, wait 3 years, someone tells you about 1202, and then you revoke your S status and say, now I got 1202 stock. No, you don't, because the day it was issued as an S. You got to issue it as a C. Okay, number 1. Number 2, just like 1244, you have to acquire the stock at original issuance directly from the corp. I can't buy Damien stock. I got to get stock from the corp in exchange for cash, services, property, exercise of option, conversion of a note, right? Directly from the corp. Number 3, it's got to be qualified small business stock. So it's got to be small. 1244, we said small was under $1 million. 1202, much more forgiving. Small means immediately after you acquire your stock, the total basis of the assets of the corporation under $50 million. 50 million, not value, basis. I mean, that's huge. You can have significant intangible value and still be a qualified small business corporation. Okay.
Yeah.
Then we have certain tests that have to be met for substantially all of your holding period. And this is where more of the gaps in the guidance start to really reveal themselves. Probably the most problematic aspect, which we won't really get into today, is similar to that operating company rule for 1244. They want 80% of your assets to be used in the active conduct of a trade or business every single year. And it can get a little wonky because after 2 years, cash can only count towards a certain amount of that test. And then real estate can hurt you. Corporate subsidiaries, if you don't own more than 50%, can hurt you. And it's based on value. So somebody's got to actually value the company every year because that intangible value will all count. And so you can have a balance sheet that's 100% cash and looks very damaging from a 1202 perspective. But if you have this intangible value that you can't see on the balance sheet, you might be just fine. So there's a lot of gaps in the guidance there. The second thing that has to happen for substantially all your holding period, you obviously have to be a C corporation, so you can't flip to an S like a year later. And then the third thing, and this is where these rulings come in, is you have to be an eligible corporation. And that just means like no discs, you've got to be a domestic corporation. But then most importantly, right, certain businesses are out. And when I say this, I know I run the risk of giving some of your listeners PTSD, but what businesses are out, buddy? It's going to sound really familiar. Businesses in the fields of health, law, accounting, actuarial science, engineering, architecture, consulting, brokerage services, financial services, right? Or the dreaded any trade or business where the principal asset of the trade or business is the skill or reputation of one or more of its owners and employees. Where do we hear that? Why will it give people PTSD?
I'm looking for a fella. Goes by Cupid. You know him?
Yeah, who doesn't? What about him?
So we've spent so much time in these terms under 199 Cap A. 199 Cap A did not create those terms. They borrowed it from 1202E. Now, 1202E is more expansive. So you heard me say architecture and engineering. They got plucked out for 199A, but they're no good for 1202, right? Restaurants, no good. Farming businesses, no good. Hotels, motels, no good. All right. But the conundrum here is that with 199A, there was this immediate rush and point of emphasis to get regulations that painstakingly describe all of these fields under the regs at 199A-5. But here we are 30 years later under 1202. We have no idea what these terms mean for 1202 purposes. And 199A says, hey, these regs are for 199A purposes, nothing else. So what happened this year is we got two rulings under 1202, and I'm not kidding, you and I, we're joking about it before, but like when I see 1202 in a weekly IRS determination, my eyes light up because any guidance we can get, we need. Now, again, this isn't earth-shattering, but I do think there's something important we can extract from that. These are two rulings about whether or not we're in one of these bad fields, one being health, one being brokerage, okay? And in the field of health, you had this company that basically doctors would come in and meet with a patient. The doctors weren't with the company. A doctor and a patient would meet and they'd say, you need this piece of equipment to help you get better. And then they would go to this company who would, make custom equipment to help somebody in their therapy or rehab or whatever it may be. So the company we're talking about is in, customized construction. They're not doctors. They're not meeting with patients. They're just helping patients get better tangentially. But they were concerned they were in the field of health because of that tangential relationship to the doctor-patient relationship. And so they went in for PLR. And to me, the single most noteworthy thing about these two PLRs is when they got around to discussing the relevant law, they don't just simply say, let's take a look at the 199A regulations, right? So that tells me they're not beholden to those regulations. They're going to interpret 1202 how they see fit. That being said, they follow the same line of thinking that we saw in 199A, which we would expect. They said, look, you're not directly meeting with patients, right? Yes, you're tangentially involved in their therapy, but you are not someone here who is sitting down with patients and providing medical advice. You don't have a license for any of that stuff. You're just building stuff out to help. So don't worry, you're not in the field of health. So that was 2021-25004 that told us that. And again, is it earth-shattering? No. Did it give us a chance to talk about 1202? Make sure everybody's aware of it? Yeah, I'm excited about that because, like I said, we need more awareness. I got a phone call maybe 3 years ago from a guy who started a company in Silicon Valley and sold his company. I'm not making any of this up. It's not one of those stories I use just to illustrate a point. Sold his company after 4 years and 9 months of holding period for $16 million. No one had ever even told him about 1202. And then I don't want to go charging down this path, but no one had told them about 1045 either. And we're not going to talk 1045 today, but just make sure everyone's aware. If you have qualified small business stock, but don't get to a 5-year holding period, you're not dead. 1045 would allow you to roll those proceeds over into replacement QSBS and preserve your potential exclusion. It's a very short provision. It works hand in hand with 1202. Again, all I care about is awareness. And then we have the second PLR, 2021-14002, that just dealt with brokerage services. And you had a company that worked with clients to obtain insurance, like property insurance and casualty and all that stuff. And they would go to the insurance company and get paid a commission if they brought clients on, but they had other duties. They had to report to the insurance companies any accidents or claims or incidents or suits or whatever it might be. They had to keep records of all transactions that occurred with the insured. And so they were concerned that they were a broker under the meaning of 1202E. Once again, they could have gone straight to the 199A language, which says, hey, brokerage services is very narrowly defined. Buyers and sellers of securities is what 199A regulations ultimately said. And so they could have done that. They didn't. Instead, they said, what's the plain language definition of a broker? It's someone who acts as an intermediary and that's it between buying and selling parties. That's not what's going on here. You're doing more than acting as an intermediary because you're keeping these records, you're reporting incidents and transactions, you're taking on ancillary roles that are above and beyond what we expect from a normal broker. And so you're not a broker. You're okay for 1202. And again, the big takeaway from that, Damien, is why not, right? We got this whole body of law under Dash 5 of 199A. They don't even mention it. They're crafting their own rules here, and all that does is spark even more concern for those of us who work in 1202 world all the time, because it means we better be pretty cautious before we go relying on the body of regs under 199A or even 448. I mean, it just looks like 1202 is going to be its own animal.
Yeah, that's really interesting, right? Because you think that would be the easy button there. I mean, I guess maybe not surprising because, like you said, the preamble, the 199 Cap A regs say
that's it.
Can't use it for that purpose, but if you're looking at the definition of health, you'd think you could maybe lean on it a little bit,
I mean, if you're going to spend all that time, right, let's use it for multiple purposes.
A leverage here. Come on,
I know.
All right. We're getting to our fifth case here, our fifth piece here, I guess. Heiting versus Commissioner.
Heiting's a really, really simple fact pattern. Okay, really simple fact pattern. You got husband and wife, they own a trust. It's a grantor trust. They're the beneficiaries. The trustee is a bank. Really simple fact pattern. The trust holds a bunch of different stock. The trustees are free to sell most of the stock anyway, anytime they want. But there's these two particular companies of stock that it holds that the trust agreement says the trustee cannot sell it unless, the beneficiaries approve of it, basically, right? So the beneficiaries can say, go ahead and sell it, we'll keep it, keep the proceeds. But the trustee otherwise, without beneficiary consent, is not supposed to sell these 2 shares of stock. So what do you think happens? The end of 2015, trustees sell the shares of stock, right? And they generate a lot of gain. I think like almost $6 million of gain. Now, this is critical. The beneficiaries don't raise an issue. The beneficiaries don't say, you screwed up, right? You've got to make us whole. The trustees go, oh crap, we didn't, we just sold stock we're not supposed to sell. Let's undo this whole thing by taking every penny of proceeds that we just got and let's go back and buy those same companies of shares. But, the market being what it is, prices fluctuate. You wait a month, you're not going to get the exact same number of shares. So they spent the same amount of money, but they didn't necessarily get put back in the same position, right? Because you end up with a different amount of shares. Okay. So what does any of this have to do with anything? Well, let's step away from the case for a second and talk simple fact pattern. You work for a company and they pay you a commission based on something you do every year. And they come to you at the end of 2021 and say, hey, good job. You did great this year. Your commission payment is $70,000. But then in 2022, before you file your tax return for 2021, they say, there was a math problem. We screwed something up. You shouldn't have gotten 70 grand. You should only gotten 50 grand. Pay us 20 grand back. All right. So what do we do about that? What we're going to want to do is say, on my 2021 return, I'm just going to pick up the net amount. I'm going to pick up 50 grand, what I ended up actually getting. Are we allowed to do that? And the answer is no. And the reason the answer is no goes all the way back to 1922, right? A case called North American Oil. And North American Oil established a critical principle for us in the tax law, right? The claim of right doctrine. And the claim of right doctrine, it's not complicated. It says, look, if you got cash in your hands that you have an unrestricted claim to at the moment, you have to recognize that income, even if some situation could arise in the future that might cause you to have to give that amount back, right? The concept being obviously that every tax year stands on its own. But yeah, the idea is if you've got cash in hand that is not, separated in some escrow account somewhere that you don't have access to, like you got cash, yeah, something could happen that you might have to pay some of it back. Your commission might have been miscalculated. You might have to pay it back. Doesn't matter. In the year you got that cash under the claim of right, you've got to pick up all that income. So what does that mean? It means the next year, when you repay the 20 grand, you'll have to deduct it the next year. Now, the thing about the tax law is, are you going to always end up in the same place? Right? Of course not. Because what if in the year you got the big commission in 2021, you were in a high tax bracket? And then 2022, you decide, I had enough of this. I'm going to become part of the Great Resignation. You quit your job and you repay this money, but you're in a very, very low tax bracket. So you picked up 70 grand of income against a high bracket and repaid 20 against a low bracket. You're not in the same place. So when that happens, we have another provision today we need to be aware of. Honestly, one of my favorite provisions in the code, and I'm well aware of how that makes me sound. But with 1341, what they're trying to do is make people whole if possible. And what it does is it says, if you meet 3 requirements, we'll give you a choice. In my commission example, go ahead if you want. Deduct the commission in the year of repayment and see where that lands you. Or go back to the year of income. Don't actually amend the return. Just do a hypothetical calculation. Figure out what your tax was with the income in there, 70 grand. Then figure out what your tax would have been if you excluded the amount you eventually repaid, and that's 50 grand. If that reduction in tax is more valuable to you than a deduction in the current year, take that reduction and drop it onto your current year return as an estimated payment so that it's refunded to you. Okay? So really cool provision. It's trying to make up for differences in tax rates and the like. The other thing that's cool about 1341 is it gives rise to awesome cases, right? Just because of the nature of 1341 and the nature of situations where you're paying back a lot of money. Now, the 3 requirements to use 1341. Number 1, you had to originally include an amount in income because you believed you had an unrestricted right to that income. That's a seminal point in one of my favorite court cases ever, which we'll talk about just briefly. I think we might have even talked about Ushio a couple of years ago. I can't remember.
We did, yeah. Tony talked Ushio in passing when covering Mihalik versus U.S., starting at 1 hour, 52 minutes, and 41 seconds in the 2019 Top 10 episode, which is episode 83. So go check it out for more discussion on the claim of right doctrine.
2, in a later year, and this is what this case focuses on, it had to become apparent to you that, you know what? You didn't have an unrestricted claim to that income, right? So in a later year, a deduction has to be allowed to you because it turned out you didn't have a claim to that income and you have to repay it. And there's a critical terminology in there. 1341 doesn't give you a deduction. There has to be a deduction available under some other provision, like a loss under 165. And as long as there's some provision that would give you a deduction for your repayment, 1341 will allow you to go ahead and use it as long as something happened after the fact that requires you to repay that amount. And requires is a key term here. And then the third requirement is an easy one. The repayment's got to be more than 3 grand. Okay. So but you could see where you could get really whipsawed now, because let's say you pick up 50 grand of commission in 2021 and have to repay 2 grand in 2022. You can't use 1341 because it's only 2 grand. So you have to deduct it in the current year. But if you're an employee repaying a bonus, once again, that's an unreimbursed employee expense, non-deductible under 67G for the next few years. It's weird. You end up paying tax on phantom income. It's such a weird consequence, but it goes back to something you and I have said in the past. Nobody in Congress really thought about the consequences when they enacted 67G. Take that concept and let's just talk quickly about Ushio, because it's just such a wonderful case. I don't care if we did it 2 years ago, it bears repeating.
No, it definitely does. Absolutely.
And it addresses the first prong of 1341. And it's just, again, it's so awesome. Ushio was a Denver guy and invested in Quest, big guy up at Quest, and got pinched for insider trading, right? Sold stock for $40 million of proceeds, arrested on charges of insider trading, got tried, got convicted, went to prison, forced to repay the $40 million of proceeds. But he's not a dumb guy. So he's sitting in prison and he's like, wait a minute, I paid tax on that $40 million of proceeds when I sold the stock. Then I had to repay it. And I'm sitting in a prison cell now and I repaid it. I'm not in a high tax bracket. I want to use 1341 to go back and, exclude that income effectively from my previous tax return, figure out what the savings would be, and claim like basically it ended up amounting to like a $19 million refund. It's just insane. And so he said, I want to use 1341 to do this. And I love this, but the IRS said, you can't use 1341 because rule number 1 says you have to have believed at the time you got the income that you had an unrestricted claim of right to that income. And you couldn't have believed you had a unrestricted claim of right to that income because you knew in your heart that it was ill-gotten, that you had gotten it through insider trading and it wasn't truly yours. Now, fascinating sidebar, we actually have another concept in the tax law called the claim of wrong doctrine, in a case called like James, basically, that tells us, for example, you embezzle income, even though it doesn't belong to you, you have to pick it up in income under the claim of wrong doctrine, but that's neither here nor there. So they say you couldn't possibly, Nacho, have believed you had an unrestricted claim of right to this income because you knew what you did was wrong. And Nacho, to his credit, said, no. You tried me, you convicted me, I'm in prison, but I never pled guilty. I still maintain to this day that I didn't do anything wrong. So you can't tell me I didn't believe I had an unrestricted claim of right to that income. And the court was kind of like, he's got us here. Now, he ended up losing in the end anyway, because they said to allow 1341 for him basically would frustrate public policy. It would not be a good look to allow this guy to get a huge tax refund after he swindled a bunch of people. And so he ends up losing. But what's important there is it makes clear in that first point under 1341, you did have to truly believe you had an unrestricted right to the income. Now we come back to Heiting after all of this. So they argued that in 2015, the trustees sold the stock. They weren't allowed to. In 2016, they immediately repurchased the stock. And it's kind of funky because I don't know why they didn't address this in the courts, Damien, but we just said 1341 is not a deduction granting provision. Some other provision has to grant you deduction. They went out and purchased the stock back. I don't know where a deduction would arise there. You'd have basis in stock, but what they wanted to do was basically say, we want to pretend like nothing happened because we got whatever, 6 million in proceeds, and then we went back and bought the stock for 6 million. So we want to go back to 2015, remove the 6 million that we picked up in income, and then claim a refund on our 2016 return for that amount, right? Which you're allowed to do under 1341. But the IRS said, you have a different problem than Nacho. Your problem is you definitely had an unrestricted claim of right to the income in 2015 when they sold the stock, but you didn't find out in a later year that you were required to repay that amount because you didn't have an unrestricted right. And the taxpayer said, no, of course we didn't. You're looking at us because the court said, you as the individuals, you were free to keep that money, right? You could approve the sale if you wanted to, so you could have kept the money. You didn't have to give it back. And they said, yeah, you're looking at us. You should be looking at the trust. The trust wasn't allowed to sell that stock, so they had to repay it. And that's where this critical distinction comes in, Damien. And they said, sorry, when we talk about 1341, we are not going to allow it for voluntary repayments. There has to be some type of compulsion, legal obligation to repay this amount. And the bottom line is the trustees sold stock they weren't supposed to sell, but you didn't object. You didn't pursue the trustees. You didn't, initiate proceedings against them. You sat back and did nothing. And the trustees saw fit to repurchase the stock, but they weren't forced. Then the court, of course, added on, and not to mention, you're not back to square one. You own different amounts of shares that you did before. But what we really learned from this, and to me, it is fascinating, is they're really going to draw a hard line between voluntary repayments and involuntary repayments. They said here again, and I think this case could have gone either way. But the point the court made was, look, you had the opportunity as the beneficiaries and owners of the trust to immediately, when the trustees sold the stock, come after them. You didn't do it. And we almost view that as like implied consent for the sale. And so the fact that the trustees went ahead and repurchased the stock, that wasn't required. There was no legal obligation to do so. Like Nacho, he didn't repay 40 million of proceeds out of the kindness of his heart, right? He was required to do it.
Had to do it, yeah.
Yeah, so really, really interesting case. Love 1341 whenever it pops up in the tax law. Anytime we get to talk about Nacho, it's fascinating. And it finishes off our three kind of case ruling run of just awareness, being aware of 1244, 1202, 1341. If we can accomplish that with people listening, we've done our civic duty, Damien.
I agree. Those are powerful code provisions, complicated in their own right, but man, are they interesting, right?
They are.
So with that, I know I'll have to start like an awareness campaign or something. I don't know, get shirts going or a little billboard campaign. I don't know. We'll figure something out. All right. So what do you think about this Barry versus Commissioner case?
Well, what I think is that we're at an hour 22 and we're right at the halfway mark. Will it be a negative split? As a marathon runner, you know the concept of we're always looking for a negative split. We want to go faster in the second half than the first half, Damien. You know this.
Yep.
I don't know.
You can hold the pace. I don't know. What do you think, Tony?
I think we're going to negative split. I really do.
All right.
All right. Barry. Why did I choose Barry? There's not a ton in Barry itself, other than it's all too common a situation that we encounter in our daily lives. And what I mean is business owners, right, trying to walk that line, that tightrope between business expenses and running personal expenses through their business. And I just want to point out when it works, when it doesn't, and the requirements, right? Barry facts are even more simple than the Heiting facts, right? You got this guy, Barry, obviously, and Barry and his kid own a construction company called Phoenix Construction. But they also love to race cars. And so they spent a good chunk of change, like 120 grand one year, getting this whole race car ready with Phoenix Construction dollars. What they didn't think to do when they went and raced their car, they raced under the name Barry Racing. They didn't race under Phoenix Construction. They didn't splash Phoenix all over the car, right? These are stupid things. These are simple mistakes. But they argued that this was a business expense because they met a lot of their clients at the races and they struck up conversations about what they did for a living, and it helped their business. Now, there's not anyone that's listening today that doesn't have a client that wants to make that argument, right? That some type of quasi personal expenditure is really helping their business. And so how do we know? How do we determine if it is or isn't? And so let's understand the baseline here, right? What I love, and I'm telling you, buddy, part of the magic in what we do here with these 10 cases is the choreography, right? Like case one, we start with section 61, which is the groundwork of income. Now at the halfway point, case 6, we lay the groundwork for deductions. It's a careful choreographed dance we do.
That's right.
Here,
it's a whole routine. You build up, it's a good plot twist here.
So section 162, right, tells us that a business can claim a deduction for its ordinary and necessary operating expenses. Now, we'll save the conversation for what does it mean to be a trade or business for case number 9. But for right now, let's focus on the thrust of the Barry case, where he's claiming we get a deduction here for these race car expenses because they're ordinary and necessary expenses of my business. But what does that mean? So the thing about ordinary, I think they're both pretty forgiving, right? Ordinary, we're told in a case called Deputy versus DuPont, it's not something that has to happen every day or every month or even every year, but it's something that we have to reasonably expect to happen in that type of business. And so the best way to illustrate ordinary is if you're a hardware store, you certainly don't expect to get sued, but if someone slips and falls outside one day in the snow and you get sued, it might happen once in the 60 years that you own your hardware store. Doesn't matter. That's an ordinary expense to defend that lawsuit because we expect those types of businesses to eventually have something like that potentially happen. Okay, but we have another case whose name escapes me at the moment, where like an artist, I believe it was an artist, got on a plane to travel for work, mixed some medications up, had a big outburst on the plane, caused a bunch of chaos, had to defend himself legally and claim that those were ordinary expenses. And the court said, no. We don't reasonably expect an artist to lose their mind on a plane and create a ruckus. And so there is a distinction there. But they're very, very flexible with that rule, right? So it could be once in a business's lifetime and still be ordinary. Make sense?
It does. It does. Okay. How about necessary?
To me, necessary is even more broad, buddy, because they just say anything that's appropriate and helpful to a business. And they'll usually let you establish that it was helpful or appropriate. We had a case called Palo Alto where a real estate conglomerate kept a private jet on standby, incurred tons of costs. But they were able to show that by having that thing on standby, they could make critical meetings across the country. They could get places that save them a ton of interest on a loan. And as long as you're able to show that it helps your business, they will allow you to decide, is it necessary to have a private jet? Okay. If it's saving you money, then we're not going to argue with you. But the classic necessary case comes from our line of work, right? The Henry case. And Henry was a guy who bought a really nice boat. I think we can go as far as to call it a yacht. And he was a tax preparer. And he flew a flag from the boat with 1040 on it. It just said 1040. And he deducted the cost of the yacht, right? Because he said, people would say to me, what's this 1040 thing mean on your flag? And he would strike up a conversation and end up building some clients. But the thing is, eventually push comes to shove. And like in Palo Alto, they'll ask you to show them how it helped you. Show us the clients you got from yachting around. And he couldn't really do it. And so he lost, right? And that's, again, the cases we always use in like grad tax to teach necessary. It's like, no. Just because you slap 1040 on it does not mean that it's a business. And we know, like, the reason I'm talking about this is because we all have clients that think that that works, you know?
And in fact, it almost like it's like ramped up in recent years or something with social media.
Yeah, that's what it is. Exactly.
Yeah,
you got TikTokers, right?
TikTok tax, advice. Yeah. Just put it all in the LLC. It'll be great, right? I think that's how it works, isn't it?
Exactly. So you need the Lori Lynn Wilsons of the world to go out there and debunk these TikTok tax videos.
That's right. That's right. Service to everybody, you know?
Exactly. So if we go back to Barry here, we're not off to a good start, but I do want to talk about a case because, again, we're here to see if we can talk about 50 different cases today from a couple years ago that shows how it can be done right. And that case was called Evans. And Evans was a guy, where was he? Idaho? I think Idaho. Something. It was either Idaho or Iowa. One of the ones with the I.
Yep. It was Boise, Idaho, and we've included a link to a Forbes article that Tony wrote on the case a number of years ago in the show notes of this episode, if you'd like to read more about it.
But he had 5 kids, he had a construction company, and all of his kids were super into motocross, right? But one of the kids, his kid, I think it was Ben, was the son that I'm thinking of, was a superstar, like a superstar in motocross. So dad jumped on board with his construction company and he sponsored Ben and he bought him a trailer and he splashed his name all over his bike and his uniform. But the thing is, right, Ben was such a superstar that other sponsors wanted him too. So other sponsors had him as well. And dad had 4 other kids that were into motocross. He didn't sponsor them. He sponsored the superstar Ben. And because of this relationship, right, because of sponsoring Ben, he got better interest rates. He got new clients. Like this kid was a big deal in this town. And he was able to show to the court that I can prove that I got better loan terms. I brought in new business. I got new clients because of my relationship with Ben. And the court allowed him to deduct a ton of expenses related to his own son's motocross exploits, really for 3 reasons. Again, he could prove it was necessary because it was helpful to his business. He could quantify it. We knew it was ordinary because advertising expenses are always ordinary. The second thing is, right, clearly there was value to his business of sponsoring his son because other people who weren't his dad wanted to sponsor Ben. So they had planned to benefit from it as well. And then third, makes you a bit of a harsh dad, but like, he didn't sponsor the other kids. He sponsored the really good kid. And so that showed that he was really determined to benefit his business, not just help his kids out. So it can be done, but you better, 1, have a kid that's pretty darn special, and 2, have a kid that other people are sponsoring as well, because it's really going to help your case. But all joking aside, like, you want to run personal expense or what looks like personal expenses through your business, you have to be able to show the IRS that they're helpful, not just say they are, show it. Now we go back to the Barry case and come full circle, our guy Barry had no chance, man. Like he didn't put the Phoenix Construction name on the car. He didn't even race under that name. He couldn't point to any way, shape, or form that paying those expenses for the race car actually helped his construction business. And so I just want our listeners out there to understand, if you want to be able to combat over aggressive clients, make sure you point out these cases to them. Show them Barry, show them Evans, and say, here's the right way to do it. Can you prove to me, let alone the IRS, that these expenditures are helping your business? Because otherwise, they look like personal expenditures that are not necessary to your business. If you can't, maybe we need to lay off the TikTok for a little while. And trust me when I say these aren't deductible.
Well, yeah, no, but I think you just make a really great point there, just that the burden of proof, it sits with you as the taxpayer, and you got to back it up, and maybe squaring it up that way to say how, if they come knocking, what are you able to do to show it and prove it?
Yeah, but those three cases really lay good groundwork between Henry with the flag, Barry, and then Evans. You can see what works and what doesn't. And it's a high bar. It's a high bar. They're not going to let you run personal expenditures through a business just because you claim that there's some positive benefit to the company.
Another one that I think it kind of ebbs and flows as we get over kind of our next case here, at least if my math is right here, it deals with Section 108 and cancellation of debt and adjusting basis. Yeah, what do we have here?
All right, I got to be careful because with 108, I could definitely spiral and we could be here in 3 hours.
You might lose your negative split there, Tony. I don't know. You gotta
we're going to negative split it. I can tell we are. I do have a couple of really important cases that have nothing to do with this case, but I do want to talk about, even though we talked about them last year. Can't trust it. We got a lot of new listeners, Damien. Right. You're drawing in people every week, every month, and they've never heard our top 10 cases, so I can't trust that they listened to last year. Between me and you, I chose this case because it's called Hussey, and it just makes me think of what my 80-year-old mother calls any teenage girl who dares to show her midriff in public. And so it's just, it just reminds me of Nana. So the Hussey case, I love cases like this because it proves that you got to follow the code through all its different cross references and all the potential implications. Okay. Very simple fact pattern for the most part. We got a guy who, through some LLCs, bought dozens of pieces of real estate over a period of years by assuming a couple $1 million in bank loans. So 2012 rolls around and he takes about half of those properties and he sells them in a short sale. So a short sale just means he sells them for far less than what he owes on the properties, but he gets the approval of the lender to do that. And usually what happens is the lender says, okay, you owe me $1 million. You're going to sell for $250,000. You still owe me $750. I'm going to forgive it. So in 2012, he sells about 15 of these properties in a short sale. He sells the remaining piece in 2016, all his remaining properties. But let's focus on 2015. He sells for such a small amount that he claims a big old loss on the sale of the property. And then he still owes the bank $750,000 and they forgive it and they give him cancellation of debt income. All right. A couple of different things to unpack here because I don't want to presume anyone understands this. Number one, what I love about cases like this, if we're up to date on our case law, we can make a determination in this case, even though the case doesn't say it. And so I'm a dork about this stuff. I love to point it out. What we can learn about these bank loans is that they were recourse and not non-recourse. And why I say that is we talked about these cases last year. I always geek out on them. I wrote about them for tax notes this year. When I say recourse, not recourse, I'm not talking about like at the partner level under Section 752, which we'll talk about in the Cubs case. I'm talking about when the bank loaned this money to this guy. Well, he assumed the loans, but you get the idea. If a loan is non-recourse, it means if the guy doesn't pay, like in this short sale situation, there's nothing that the bank can do about it, right? They can only take the money he gets from the sale and they have to walk away from the rest of the loan. So they bear the risk of loss. If it's a recourse loan, it means not only can they force the taxpayer to sell the property, for example, at foreclosure, but if the amount doesn't cover the debt, they can go pounding on the door and say, you still owe me some more money. So how do we know this loan was recourse and not non-recourse? Because we learned last year, Damien Martin, If it's a non-recourse loan, the Tufts case tells us that the entire amount of the loan is included in your sales price. And there can be no cancellation of debt income for two reasons. One, all the debt is actually in your amount realized. And two, how can there be cancellation of debt income when the lender was never in any position to collect that debt, right? Like they couldn't enforce it, so they can't forgive it. When it's a non-recourse debt, the Tufts case would tell us you can't have this result, a loss on the sale of property and then COD income. But if it's a recourse debt, the Ozawa case tells us you have a bifurcated transaction. Treat the property as if it were sold for what it was sold for, recognize gain or loss, and then you still owe the bank 750 grand. If you pay it, no harm, no foul, no further consequences. But you ain't going to pay it because you don't have the money. So if the bank forgives it, then you have cancellation of debt income. And since here they had that split transaction, a loss on the sale of property and cancellation of debt income, we can infer that it was recourse debt, which has absolutely nothing to do with why we're talking about this case, but this is what we're here to do. So they pick up $750,000 cancellation of debt income. What does that mean to our listeners, right? If you're not familiar, well, under an old Supreme Court case called Kirby Lumber, we found out that if you borrow money from somebody, that's not a taxable event. But if the lender eventually says, don't pay me back, keep it, well, now you're richer than you were. And under Glenshaw Glass, which we talked about, you've got taxable income. Eventually, that was codified in Section 61A11. So now when debt is forgiven, we have cancellation of debt income. Okay, great. But anytime we have cancellation of debt income, we immediately have to turn to Section 108, because 108 provides a series of exclusions against cancellation of debt income, which I hate to call exclusions because, as we're going to learn here today, they really operate more as what? Deferrals. And the idea here is if you're in such bad shape that you just had a bunch of debt forgiven, you're probably not in a position to pay a tax bill on the COD income. So like 108A1A tells us you have debt forgiven in a bankruptcy, well, you're not in a position to pay that tax. And so you don't have to pick up the income, you can exclude it. But how does it operate as a deferral? The price we pay for not picking up the income is we have to reduce attributes. So things like net operating losses or capital loss carry forwards or whatever it may be. And so in a future year, when you go to reach for that NOL and it ain't there anymore, it's a deferral because now you're going to pay more tax than you otherwise would have. Same thing happens under 108A1B if you're insolvent but not bankrupt. We've got exclusions under 108A1E for principal residence, 108E2 for liabilities that would have been deductible, E5 for purchase price reductions, all sorts of stuff. But what we're focusing on here is one of those areas that gets the least attention. All right, 108A1D. And what this was designed to do is to not immediately punish real estate investors who suffer big losses because property value goes down. So if you have a non-corporate entity, which is usually what you're going to have, right? So this doesn't apply for real estate in a C Corp, but how often are you going to see that? So if you have non-corporate entity owning real estate, let's forget the sale concept right now, okay? So you own real estate and you go to your lender and say, I can't pay this mortgage. The property value's gone down. I'm not collecting enough rent. Forgive $1 million of debt. All right. 108A1D says we will forgive that $1 million of debt. But the way we're going to make it a deferral is at the beginning of the next year, first day of the next year, you're going to reduce your basis in all your depreciable property by $1 million. And so we find under 108, your exclusion is limited to, you got to have enough basis, right? If you have $1 million of COD, you better have at least $1 million of depreciable basis. But if you do, no problem. You don't pick up the income currently. You simply reduce your basis in the depreciable property on the first day of the next tax year so that now you don't get depreciation deductions. Now you're going to have bigger gain when you sell. Okay? So that we can see how it works in the deferral context. But what's fascinating here is we did have a sale, right? We had a sale of 15 properties in 2012. And the taxpayer said Section 1017, which governs reduction of attributes, says reduce attributes on the first day of the next year. And so I can take a loss on these properties because I don't have to reduce the basis until the beginning of next year. Fair enough. Okay, but is he right? Depends. You got to read the law the right way. 108C2B says, as I mentioned to you before, you can only exclude COD under 108A1D to the extent you aggregate all the basis of your depreciable property and you have enough basis there to support that reduction in basis for the COD. So you have 750,000 of COD like this guy does, you better have at least 750,000 basis. He had more than enough basis, more than enough. Matter of fact, the basis in the property he didn't sell, so the property he sold the next year, was also more than 750,000. And that becomes relevant, okay? Because if you read the fine print and you kick over to 1017, 1017 says, yeah, generally you reduce your basis in property on the first day of the next tax year. But then 1017 B3F, Damien, says, hold on. If you sold any property during the year and that property was part of the property you aggregated to determine you had enough basis to absorb a reduction in basis, then you have to reduce the basis in the property immediately before the sale. So think about what that means. That means he wanted to reduce 750,000 basis at the beginning of the next year. The IRS is saying, no, the property you sold in 2012 should have been reduced by 750 immediately before the sale. And what does that mean? That means 750,000 of more gain. And the taxpayer made one last ditch argument. He said, yeah, but I didn't need that basis to support the reduction. I had more than 750,000 of basis in the remaining property I didn't sell. And the court said, don't care. That's not how the language reads. The language says if any property that was part of your aggregation is sold during the year, whether you needed it or not, you reduce that basis prior to the sale. So that's a $750,000 swing in income, right? Because he wanted to do it next year, and now all of a sudden it's happening in the year before, and he's got to pay the tax well before he wanted to.
You talk about just mining the details there. I mean, just the complexity of 108 is, and just the intersection there. Wow, right? You really got to plan that through and follow the code section.
Yes, I mean every step, right? Because and those code sections aren't even next to each other, right?
No,
I mean,
right? I guess that's kind of what I'm thinking there too. You're bouncing around a little bit, you know?
Yeah, because you got 108 in the exclusion provisions that run from 101 to 140, but then you got 1017 in the basis adjustment provisions up in subchapter O. Yeah, they're not even next door, so you could see how you screw that up.
Well, yeah, and I think that was always the thing as like a student, I consider myself still to be a student of the tax law. I think you kind of almost have to be to have the respect for it that it deserves. But, just always thinking, well, gosh, how am I going to remember and think about these code sections, like you said, when they're not even adjacent to each other? Like that just seems so difficult, so hard,
Yeah, but again, that's a good one for awareness too. I mean, 108A1D, I think, slips through the cracks far too much.
I definitely agree. All right. I think we've come time here where, you've teed it up a little bit, coming back to my, hometown here of Chicago and the Cubs. What happened with Tribune Company versus the commission? I have to say, because I'll pause here and say this, actually, this and the next case, when reading them through the year, in cases in general, I think, I wonder if this is going to make Tony's list. And it's like, I have a feeling this one's going to make it. So yeah, what happened and why is it important?
I'd be lying if I didn't say to you, listen, I'd love to have left this off the list because it's a pain in the butt case. It's complicated stuff. You're talking about nearly $1 billion changing hands. It's a 70-page read, but we've been waiting for this case for a while, ever since Canal Corporation came out and really drew attention to leverage partnerships. We've been eager to see how this would go. And then the fact that it ends up being a split decision is kind of fascinating as well. And I know that, we're going to get a little bit into the weeds here with partnership law, but we'll keep the sports fans. We'll lose the people that hate subchapter K. We'll have a healthy mix here. We'll see how it goes. It's fascinating stuff, right? Because what have we been talking about here today? We've been saying you do 1031 exchanges, exchange property for property, no cash. Okay, that'll be tax deferred. Why? Because you haven't cashed out your investment. You've just changed the form. It's a statutory concession. All right. We talked about 1202 being a rarity in the law where you can have cash and not pay tax. But what we talk about here is the fact that everybody wants that. Everybody wants cash, at least without current taxation. And sometimes, if you really dissect the law and have smart people at the helm, you can make it happen, at least to some degree. Now, this is 2 consecutive cases, big cases, $700 million plus, where things have not worked out perfectly with the taxpayer, despite having the best advice from the best tax firms. But let's talk about what's going on here with the Cubs, right? So the Tribune company, the media company, owned the Chicago Cubs. They went through some hard times. They went through bankruptcy, but it's critical to understand that you can go through bankruptcy and still have plenty of assets on hand. And that was the case here. And that's a critical distinction when we compare it to the Canal Corporation case. So Tribune was going through some tough times, was in a bankruptcy, had plenty of assets, but decided it was time to sell the Chicago Cubs. And they, went through a long process and eventually identified the Ricketts family as being the buyers that they wanted to get engaged with here. So think about it. Let's just talk simple numbers, right? The Cubs didn't have much in the way of basis to Tribune Company. I mean, these aren't the exact numbers, but we're just going to ballpark them for our purposes. Let's call that basis $5 million. The thing is, the Cubs were worth $735 million. So if I own the Cubs and I say to Damien, hey, pay me $735 million in cash today, I'm going to have a tax bill, if my basis is $5 million, on $730 million of gain. That is not going to be an acceptable result to any savvy, sophisticated person, because they're going to say, I'd rather pay someone else to figure out how to get me out of the tax bill than pay the actual tax bill. But you can't have your cake and eat it too in the tax world. You can't have cash and not pay tax, or can you? Well, here's how they try to set it up. And it's called a leveraged partnership. And if I could geek out, I'd be drawing stuff for you right now. But you've got Tribune, and they take the whole Cubs assets, everything they got, right? I don't even know who the Cubs assets are anymore. They gutted everything. Baez's gone and Bryant's gone. Who's left?
Rebuilding here, Tony. It's a rebuilding.
Yeah, I mean, again, they pretty much gutted everything there.
Pretty much, yeah.
So they drop those Cubs assets into a partnership. And remember that the Cubs assets are worth $735 million, but they only have a basis of $5 million. So under Section 722, you drop something with a basis of $5 million into a partnership, your basis in the partnership interest becomes $5 million. Okay,
Yep.
Fair enough. Then the Ricketts family puts in $150 million of cash. And you're like, all right, well, that ain't going to do us a whole lot of good because the Cubs are worth $735 million. We want $735 million. Why is the Ricketts family only putting in $150 million? Here's what's even weirder. You put in the Cubs for $735 million, Ricketts put in $150 million, but the ownership percentages say Ricketts own 95%, Tribune owns 5%. Well, how can that be if Tribune put in Cubs worth $735 and Ricketts put in $150 million? Because the plan all along was that cash was going to come into the partnership and immediately go out to Tribune to dilute their interest. But where is that cash going to come from? It comes from 2 sources, and both of them are critical in this case. First, they go out and borrow $425 million from a bank. And the bank's not messing around here. Like they said, hey, there's a waterfall deal in the partnership agreement that makes sure we get paid first, and we have priority over any other debts you take on. We have all priority. We come in front of anybody. And more importantly, we're going to need a guarantee from somebody on this. But this isn't a problem. In fact, this is exactly what they wanted. This is what they designed. And we'll get into that, okay, in a minute. And so we got $425 million coming from a bank. And then we had $250 million loaned up from an affiliate of the Ricketts family. So it wasn't directly from the Ricketts partner, but from an affiliate. And this debt couldn't have been more highly subordinated, right? Like they couldn't come after the partnership until all sorts of avenues were exhausted. With the first debt, this debt couldn't even be paid until the first debt was paid off. The maturity date was subject to the maturity date of the first. So in any way you could possibly subordinate this second affiliated debt from the Ricketts family, it was subordinated. But then what was even more interesting is we knew that cash was going to come out of the partnership and go to Tribune right away. And we knew we were going to end up with this 95-5 split with Ricketts owning 95. But the only way they could get to a true 95-5 split mathematically, and this was an egregious error by the lawyers, if you ask me, is if that 250 million the Ricketts family put in was really representative of equity and not debt, right? Only by making that part of their capital would the percentages work. And that becomes very, very critical. So now, Damien, there's $675 million of debt at this partnership. And this is exactly done by design, because now what's going to happen is Tribune is going to guarantee both debts. And they're going to say, hey, if the partnership doesn't pay it, we will pay the debt. Why? Well, we'll get to that in just a minute, right? But they do that. They guarantee it. They have the assets necessary to pay it, because even though they're in bankruptcy, they've got over $1 billion in assets, but they go ahead and they guarantee the debts. How does this all fit together? Okay. What's going to happen now is, now that this cash is inside the partnership, they are immediately going to take $705 million of cash. So 675 of the loan plus an extra 30 of the 150 million, and distribute it out to Tribune. So let's just think about what really happened here. Tribune put assets with a basis of $5 million into a partnership, and the next day got $705 million of cash. What does that look and sound and smell like to you? A sale, right?
Sure does. Maybe in disguise, but certainly sounds like one to me.
So it is a disguise sale under the partnership rules, right? A 707. They say, look, if you transfer appreciated property to a partnership and within a 7-year window get back cash or other distribution of property, it looks and smells and sounds like a sale, so we're going to tax it like a sale. So if we stopped right there, they would be treated as if they sold assets with a $5 million basis for $705 million, right? And they'd have whatever that is, $675 million a gain to deal with. Okay.
Right. Okay.
This is where the savvy attorneys and tax people are so valuable. They kick in and they read the regulations 707 and 737, and they say, wait a minute. If a distribution is what we call a debt finance distribution, so a distribution comes out of a borrowing and it's going to the party to whom that debt is allocated under the partnership rules, then that piece of the cash that changes hands will not be considered proceeds in a disguised sale. And so what's critical here is, under the partnership rules of Section 752, when the partnership borrowed $670 million, where should that have been allocated? We all know we allocate liabilities under the partnership rules. We all know that the K1s say who gets what piece of recourse, non-recourse debt. Normally, we would say, if Tribune family guaranteed all the debt, they bear what we call the economic risk of loss under 752. They would have to pay the debt if it goes bad. And so we'll allocate it to them. And that's what they did. So by allocating the $670 million of debt to Tribune, and by distributing the $670 million of debt to Tribune, that debt is removed from the disguised sale rules. So Tribune said, yeah, we did have a disguised sale. We sold $5 million basis Cubs for $705 million less $670 million of debt finance distribution that's removed. So $35 million of proceeds, $5 million of basis. We'll pay tax on $30 million of gain. We also got $670 million of cash in the coffers. We're just going to ignore that for now. Now, again, it's a deferral, because when you take the distribution of your debt financed proceeds, you had a basis in that $670 million of debt that went down by the distribution. So when you now repay the debt, you'll recognize the gain. But the point is, you got $670 million of cash and you control the timing of when you recognize the underlying gain. That's a pretty nice gig if you can get it. So what we had here was, we knew for years that the IRS had challenged this sale as being abusive, and that Tribune shouldn't have been able to use the debt finance distribution. We knew they were going to come after them and say, you should have picked up that extra $670 million as gain. And that's exactly what they did. And the IRS made two competing arguments. Number one, the debt from the Ricketts family affiliate, for whatever that ended up being, $250 million or whatever it was, they said, and this is fascinating because I didn't know the case was going to go this way. They said, forget the analysis of whether the debt should be allocated to you or anything like that. We don't actually think it's debt. We think it's equity under debt versus equity principles. Now, I don't know if we covered, I think we might have covered the other direction, whether dividends or salaries, but anytime you make a purported advance to a business, it could be debt, it could be equity, right? And we have factors that tell us. And depending on what circuit you're in, it's going to drive which factors they look at. But they'll look certainly at the formal indicia of the debt. If you don't have an interest rate and a maturity date, that is not going to look good. Now, in this case, they had an interest rate, but the maturity date was dependent on the maturity date of the bank debt. And so it wasn't fixed in time. That is not a good factor. Another very bad factor for Tribune was the fact that it was so heavily subordinated to the bank debt. The agreement made it very clear that all the bank debt had to be paid and only leftover money could be used to pay this second debt. That makes it smell and sound more like equity. One of the biggest factors was what I said to you. Only by treating it as equity would the percentage ownerships fit 95 and 5. If you treated it as debt, it was more like 86 and 14, whereas if you treated it as equity, it was 95-5. That was not a good look at all. And then they will also look at your use of the funds. And if you put money into a company that's immediately used to acquire assets, the courts over the years have said that looks more like equity than debt. So long story short, they kicked the tires on the different factors here used in the relevant circuit. And they said, we think this is equity, not debt at all. And so if it's equity, you can't use the debt finance distribution exception. That's $250 million of cash that went out to you that is now additional gain. So that's $250 million right off the bat that Tribune Company has to pay additional tax on. So they lose on that side, right?
Right. Like you said, there's a lot to this one. You got to unpack it,
No, and we're only scratching the surface.
I know. You almost see like a 7th inning stretch or something if you're going to throw in a baseball metaphor here.
Yeah,
It's just, man, there's a lot.
Yeah, but we've been waiting for this one for a long time, and it's because of the second challenge. The second challenge is the IRS came in and said $425 million of bank debt. This should not have been allocated to Tribune under the 752 rules for a variety of reasons. Number one, they said they don't actually bear the risk of loss if the LLC doesn't pay it. Number two, they argued that the guarantee was so contingent they would never have to pay it because the lender had to really, really pursue a bunch of legal remedies against the LLC before they could go after Tribune. Then they argued that they didn't have enough assets to pay it if they were called upon to pay it because they were in bankruptcy. And finally, they referenced a bunch of broad anti-abuse rules in the partnership regs, right? Now, the reason they launched this attack is because we had an unbelievable case that at this point might have been 5 years ago. I don't even remember. But Canal Corporation, same exact basic structure, Damien. Somebody wanted to sell a tissue business of all things for like $750 million. Who knew, right? And they did the same thing. They put the business into a partnership. Somebody else put some cash in. They borrowed a bunch of money and they distributed it out to the seller. But in Canal Corporation, the seller had distributed all of its assets to its owners, so it had no assets left, and it didn't actually guarantee the debt. It provided an indemnity in case the primary guarantor didn't cover the debt. And what happened in that case is the court went in and looked at it and said, it's an indemnity, it's not a guarantee, and it's meaningless because even if you were called upon to pay it, you don't have the money to pay it. And so what's remarkable is, again, without signing blame here, they had an opinion letter from a big four accounting firm that transaction would work. And it did not work. And when you talk about interest and penalties on $700 million of gain, it's hefty, right? Really, really hefty. And so Canal Corporation was problematic enough that they wanted to revamp the 752 regs. And they did draft those regs, but they ended up getting nixed by the Trump era reduction in regulation kind of requirement. But they would have put a lot more requirements on guarantors to get allocated to them under the partnership rules. But coming back to the Cubs, they launched very similar attacks on the Cubs and tried to draw a parallel to Canal Corporation. But in this situation, we found that the advisors for the Cubs did things right for this $425 million of debt. It wasn't simply an indemnity. It was a guarantee. And even though they were in bankruptcy, they had $1 billion of assets they could have used if they were called upon to pay the guarantee. And yes, there were a host of provisions requiring the lender to go after the partnership. But what they look at to see if you should be allocated recourse debt is a worst case scenario where every asset of the partnership goes valueless, is sold, and the liability becomes due and payable. Who has to buck up for it? And in this case, they said it's very clear based on the documentation. It's not the Ricketts family, it's Tribune. Tribune would have to pay this, right? They drew this other distinction, which I kind of find interesting. I know I'm getting into the weeds, but in the Canal Corporation case, if the party had actually paid the guarantee, they would have gotten an increased ownership interest in the partnership. That's a bad look. In the Cubs case, if they paid the guarantee, their interest didn't go anywhere. And so they tried to make some anti-abuse claims. They tried to argue that it wasn't a real guarantee. It didn't impact Tribune in any way, but it affected their credit rating, right? It had a real impact. It was presented on the financial statements, albeit in a small way. And so long story short, the court came out and said, unlike Canal Corporation, Cubbies, Tribune, this $425 million of bank debt, it was right to be allocated to you. It stands up as a debt finance distribution. And so you don't have disguised sale proceeds for that $425 million. You do for the $250 million of Ricketts debt, but not the $450. So it was $425, whatever it was. So it was a split decision, right?
Right.
They lost the $250. They won the $425. We'll see where it goes from here. What I would love, and I haven't, undertaken this just yet, is for someone who knows Subchapter K better than me to go back and read the proposed 752 regs that had come out and said, okay, let's take these Cubs facts now. And if these regs had been relevant at that time, would we have gotten a different result? Right? Let's look at the requirements for a guarantee and see how that would have worked and the debt finance distribution rules. But it's really amazing. I mean, it's amazing when you think about they were one small misstep in the debt equity analysis away from having $705 million in their pockets and only paying tax currently on $30 million. Now, eventually, like I said, you're going to pay the tax, right? Because once the liability gets paid off, then it's a deemed distribution. You got no basis. It all gets triggered, but you control that timing.
Yeah. Well, I mean, in the name of the game in tax planning is generally deferral, right? So, I mean, that's what we're trying to do here. Yeah, that would be a fascinating analysis. I mean, I always find, and I'll get your take on this too, when you have things like proposed regulations that get put on the shelf and don't go anywhere, or even proposed legislation, I mean, it's fascinating because you never know when it might come back off the shelf or something, and what the viewpoint is that went into it.
Yeah. And, is the government going to be angry enough about this split decision that, there is a point of emphasis to get those 752 regs back? I don't really know. But yeah, we've been waiting a long time for this one, and it's not an easy read by any stretch. And, I'm sitting there trying to do the math on, you have to kind of back into how they came up with because, they acknowledged it was a disguised sale. They paid tax on 30 million. They just said that the other 670 million was covered by the debt finance distribution. So you're just trying to work through the math and figure it all out. And it's not actually as long as a read as I thought it would be. It's, it's more like 70 pages, which is tolerable.
And still some heavy stuff in those 70 pages, perhaps. I guess anytime it's okay, it's some heavy stuff. But
Well, it's not. I mean,
you know,
K is not for the faint of heart, man. And this is the worst part of the worst subchapter in the code.
yeah,
Like
yeah,
737 and 707. It's a mess.
yeah. Well, worst or best, depending on the vantage point on the tax law, I guess.
Yeah, exactly. I think if you're a Tribune company, you're pretty happy with subchapter K right now.
Right. All right. Well, we're getting to another case here that I remember when it came out thinking, oh, this is pretty fascinating. And I'll bet this is one that Tony might pick up. And this one deals with self-employment tax. So what do you got here on their 9th case?
I dig this one. And I'm looking at the clock and I think it's going to be close, but I think
I'm watching your pace here, Tony, you know.
I think 2 hours, 44 minutes would be an even split. And I see us coming in under that. I really do. Karen Slaughter. All right. I don't know Karen Slaughter's work, but she's apparently a very famous crime writer. And that's important because as a famous writer, she gets publishing contracts that other people don't get, right? They give her the benefit of the doubt. And it's because she's what they call a brand writer, which means, sometimes people will go into a store and not even ask for a specific book. They'll just say, give me something by Karen Slaughter. And so to publishing companies, that's worth a lot. For Karen Slaughter, she wants to keep that brand up. And so she spends money to help build that brand, right? I mean, she goes to publishing forums. She rents an apartment in New York City that she can stay at from time to time to meet with publishers. And so she's spending amounts to protect her brand. And what's critical here is, I'll give you one guess. You think her and her accountant deducted the cost to protect her brand and all that stuff she spent? Of course they did, right? And they did it as a business expense against her business income. And again, that'll become relevant here in a couple of minutes. So she gets paid well. And her contracts say, we're going to give you an advance and then we're going to pay you royalties based on sales, obviously. But because she's a brand writer, the contracts also say things like, we have the right to use your name and your likeness and your characters in marketing material. Okay, fine. So in the 2 years at issue, let's just say she was paid $2.5 million each year under these contracts. Now, we don't have the dispute you might think we have. It's not like she argued any of this wasn't income. She knew it was income. She conceded it was income. What she did, though, is said, hold on, I'm really getting paid for two different things. I do my writing, and then I have a brand, and I have intangible assets like my characters and stuff like that. And the truth is, and I didn't realize this is how it works, Damien, and it tells me if only I could be a better writer, there's a nice living to be made out there. She would only spend 15 weeks a year writing her book, right? She would write one book a year, 15 weeks to knock that book out. That's pretty impressive, right? So what she did is her accountant, I don't know who got the idea. They said, hey, we acknowledge this is all income, but we think only the income we get attributable to writing should be subject to self-employment tax. How are we going to figure that out? Well, it takes me 15 weeks a year to write a book. 15 divided by 52, that's how much income I'll subject to self-employment tax. Everything else, I will say, is not related to the business of writing. It's related to my intangibles, my name, my likeness, my characters, and that I'll pay income tax on it, but I ain't paying self-employment tax on it. And so that's what she did. And it's really, really fascinating. She's not the first person to make this argument in the writing realm, right? But we got two issues here. Number one, section 1402. 1402 says you are going to pay self-employment tax on income derived from your trade or business. All right, fine, right? There's that clause, trade or business, we said we'd come back to. Now, she argued that the brand piece of her writing was not a trade or business. She argued it was too sporadic, right? Too inconsistent, right? We talked earlier today that 162 gives you a deduction for ordinary necessary expenses of carrying on a trade or business, but we said we don't know what is a trade or business. And it's not defined in 162. Case law helps us. The seminal case is one called Grotzinger. Again, continuing the trend of self-promotion, I just published an article examining Grotzinger for tax notes, I think last month. But Grotzinger is about a gambling case. And it just says, hey, you don't have to sell a product or sell a service to be in a business. If you conduct any type of activity with continuity and regularity, that's a business. But if it's too sporadic or if it's a hobby, that's not a business. And so she was trying to argue that her brand, that what she was getting paid for the brand was not a business. Two problems with that argument, Damien. Number one, what did I say to you in the outset, right? The expenses she paid to build her brand. You think she deducted those as business expenses? Yeah.
Oh yeah.
Yeah,
Oh, yeah.
She did. So how can the brand not be a business if you're deducting them as business expenses? Number two, she's arguing that the brand building is sporadic, but she only did writing for 15 weeks a year. If anything, it sounds like the writing business was more sporadic, and nobody would argue that the writing wasn't a trader business. So if the writing was a trader business, then the brand work had to be a trader business too. So we acknowledge now that all of it is a trade or business. Fine. But that doesn't mean the income is necessarily self-employment income. There has to be a nexus between the income received and the underlying trader business. And she continued that argument that, hey, there is no nexus here because I get paid for the brand work regardless of how much time I spend writing during the year, or even if the writing isn't good. Even if I lay an egg with a book, I'm getting paid for the brand work. So there's no nexus between the writing I do and the brand payments. That's completely unrelated. I'm going to get paid whether this book is good or not, whether it takes me 15 weeks or 2 weeks. Reasonable argument. The thing is, the court said, okay, but what if you stop writing entirely? Right? If you don't have your writing business, is anybody paying you for your characters and your name and your likeness? No. This all disappears real fast if you stop writing, right? So don't tell us it's not tied in any way to your writing business. Without the writing business, none of this happens, right? So all of these intangibles you say you have, if you stop writing, no one's going to pay for your name or your likeness. The promotional payments are undeniably tied to the actual underlying writing. There's a nexus to the underlying trader business. It's all subject to self-employment tax.
Yeah, and it makes me think. I mean, actually, this thought occurred to me when we were talking 1341 earlier and claim of right that you try to take a logical or a reasonable approach, and I feel like that's always like the setup for a good tax court case, where it's not going to maybe end so well too. And I know you've said this before. Sometimes you like to, when you get the cases, you just start to in the setup start to think like, I wonder which way this one's going. Yeah, you start doing things that seem logical, or okay, I can see it where you're going with that. That might not be the best way to get a tax deduction, or in this case, the treatment that you want from self-employment tax perspective.
Well, the beauty of these two cases, plus the Heiting case in 1341, is like you said, if we were sitting here talking about them and they had gone the opposite direction, would we be surprised? I don't think so. I mean, they all were just kind of hanging by a thread. It depends in part on your interpretation. Those are fun. Like you said, the fun ones, when you read the facts to the Barry case with the race car, you're like, all right, I know how this story ends, but what can we glean from it? But some of these other things, like the Forte case with 121, you start reading, you're like, I don't know. This is going to be fascinating. Let's see what they say.
I think we're at 22 or 23 cases before we get to this next one. So we're doing pretty well here. I was along the way, I was starting to do rulings and letter rulings and all that, but I ran out of fingers. I don't have the 10 key, Tony, anymore. I swear it's, that math gets a little complicated. Actually, we're at 24 cases right now. And with this next one, it'll bring us to a grand total for the episode of, 25 cases, 19 Internal Revenue Code sections, 5 letter rulings, and a pear tree of Treasury Regulation sections. Rounding out on number 10 here with a deal with management fees, or purported management fees, perhaps. So what do we got here?
I like this case too because we see it a lot, right? And what I mean by see it a lot is we see steps taken by a business, particularly a corporation, to zero out taxable income. And that's fine, right? But we have to acknowledge that when you're zeroing out taxable income by making payments to shareholders, because you say they're deductible payments, does not make them deductible payments, right? And I also like to always go through
the discussion with you and make sure we get at least one case that has one of the good factor tests. I like factor cases. They're always fun. You never really kind of know how those are going to go because it depends not only on the factors themselves, but the weight of the factors.
Right.
Simple fact pattern here. You got a C Corp that had 3 shareholders, right? You've got an individual who's also the president of the corporation who owns 20%, but then you have 2 corporations that own the remaining 40%. Now, no denying the president worked hard every single day. He's putting in 12-hour days, a lot of experience, a lot of responsibility, whatever it may be. The other 2 corporations, there's a tangle of facts in this case, but long story short, people affiliated with the other corporations did provide some services to this Aspro company. There was some type of service relationship, but what there wasn't was any kind of management or service agreement between Aspro Inc., the corporation we're talking about, and any of these other parties. But that didn't stop Aspro at the end of every year from making payments to all 3 shareholders that they called and deducted as management fees. And we see this a lot in practice. We really do. And what those management fees did, as you can probably guess, was more or less zero out the taxable income. But the other thing is there's just some glaring red flags. The payments were pretty much in line with ownership percentages. So 20, 40, 40. And that's a bit curious because you're telling me that the value of the services provided in these management deals was exactly 20, 40, 40? That seems like a bit of an unlikely result, right? And then more importantly, this company had never once paid out dividends. So you have 3 things working against the company here. You're zeroing out income every year, paying amounts that are proportionate to stock ownership when you have no history of dividends. And then you take the individual president, and if you add that payment at the end of the year to his regular comp, he's well over $500,000 of compensation, right? A pretty big amount. And what we learn here, and it's just dealing with our clients, is that you can call things whatever you want. Like we said before, you can call, Tribune company could call something a debt. It turned out it was equity, right? Here, you can say these are management fees and deduct them. But when they're going to shareholders, obviously the IRS can step in and say, no, what these truly are dividends, right? And if they're dividends, at the shareholder level, you're almost happy, right? Because you've given away comp taxed at ordinary income rates if you're an individual in exchange for dividends that are taxed at favorable rates. The 2 corporate shareholders as C Corps, they're weighing regular income versus dividends received deduction income. So they have a benefit too if it's a dividend. But at the corporate level, as the payor, you lose the deduction. So now all of a sudden you're paying a whole lot more corporate level tax. And that's what raises the awareness of the IRS, is you're zeroing out that income, claiming you have deductions for management fees. And so we have a reg, right, under 162-7 that makes very clear that any amount paid to a shareholder that is greater than the value of services that shareholder has provided to the corporation ain't compensation, right? It's a dividend. We have over the years developed a series of factors that we look at. And what the case did here is it broke it into tranches. It first looked at the payments to the 2 corporate shareholders, 40% and 40%, and then to the president. And so for the 40 and 40, they just said, look, is there a history of dividends? If there's a history of dividends, then that makes it more likely that this isn't a dividend. But they had never paid any dividends in their life, right? And then, of course, they ask, are these payments made pro rata? Because if they're pro rata, it certainly looks and feels a lot more like a dividend, because what is the likelihood that the value of the services provided happen to be pro rata? And that's a big problem. I mean, a huge problem. I mean, how can payments be the same? There's no way the services provided were exactly the same. Now, you could also argue, which the court and IRS did, is that, hey, if you have individuals at these corporations providing the services and not the corporations themselves, you probably should have been paying the individuals and not the corporations, right? And then, okay, if they're providing services all year, which they were, why are you only cutting checks at the end of the year? That looks a lot more like a dividend. And then naturally they'll say, what effect did this have on taxable income? And when you go through 3 straight years and it's pretty much zeroing it out, that ain't a good fact pattern either, right? I mean, if it weren't having that type of effect on taxable income, you'd probably stand a better chance. And then, of course, if you're going to claim something's a management payment, they're going to say, show me the management agreement. They didn't have any management agreements to show. So the payments to the two corporations, 40/40, identical, they made quick work of it. And they said, these are not deductible management fees. These are dividends. They're dividends. And so the corporations had to deal with that accordingly. And then more importantly, the payor couldn't deduct those amounts.
It seems like, like you said, it all comes down to the factors and being able to document and support the management fee. I mean, I guess absent being able to demonstrate that it's not in accordance with ownership or something along those lines. I mean, that really doesn't put you in a good spot.
Nope. So then they had to jump over, Damien, and say, well, what about the payments to this president? Because he's different. We know he's provided a lot of services. We know he's worked hard. So are these dividends or are these just more of his compensation? And there's a little bit of a subtly different set of factors they looked at for an individual who's providing services. They look at his qualifications and how much responsibility he has. And in this case, the guy had extensive experience. He worked hard. That looked a lot like compensation, right? They look at the general economic conditions and, could you pay more comp? And they're like, actually, during these years, times were a little bit lean. So highly unlikely it was comp, probably more of a dividend similar to what was paid to the other two guys. Then, of course, they look at the prevailing rates of compensation. And they said somebody in a similar role as this guy would have gotten about $280K. If we treat this additional payment at the end of the year as comp, he's over $500K. If we treat it as a dividend, he's more in line with what was reasonable for his level. And so that makes it look more like a dividend, right? And then one thing that I've always struggled with in the tax law, trying to understand it, and they use it in these reasonable comp situations. They didn't delve too deep into it in this case. They look at what they call an independent investor test. Would an independent investor be cool with the president being paid what he was in compensation, or would that compensation being paid out reduce the independent investor's return on investment to a point that they wouldn't be happy with? And in this case, they ultimately looked and said, man, these amounts zeroing out income every year, going out as compensation, if I'm an independent investor, I'm not happy over a period of years that this president's getting $500K a comp and I'm not getting enough return on investment in the form of dividends. And so same thing. They looked at the president and said, when we analyze all the factors, you can call this comp all you want. It's not comp. It's excess comp. It's a dividend. And so now we got dividends to the president and to the two corporations. Boom. We're done, Damien. We did it.
Tony wasn't kidding when he said you'd get more than advertised with this episode. Well, what do you think? Did Tony deliver again this year or what? We would really like to know, and here are 3 ways that you can do so. First, leave us a rating and review on Apple Podcasts or wherever you find your podcasts. Second, drop us an email at simplytax@bkd.com. And third, find me out on social media and connect with me. You can find me on Twitter, where I tweet about tax at Damien Martin CPA. On Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad. On YouTube, by subscribing to our Simply Tax YouTube channel, which, by the way, is where you'll find the videos for each of the top 10 cases that we covered today, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.